but maybe what I'll do is just share my screen and give you the sort of introductory stuff. By the way, all the slides and things, all the presentations and all the things that we deal with will be on the SharePoint site before, not the SharePoint, sorry, Canvas. Sorry. I'm a technology platform behind the Canvas site before the course. So that's if you ever need anything, it should be there. And so so what I thought I'd do is try to explain what we're going to do and sort of get into the course in a way. In terms of the sort of, let me just plan here. So what I want to do in this first hour is to give you that sort of course overview, what the structure of it will be, what the assessment of the course is, and then go through sort of do a sort of introduction to some of the issues and some of the data on the financing of early stage ventures. So that's really the sort of plan of this session. You know, as you'll probably remember or know from the time we were deciding whether to take this course, you know, what we're going to be focusing on are these financial decisions associated with very high risk ventures, very early stage ventures, which typically don't have any cash flow, are sort of, you know, are still having to go through the valley of death in terms of financing through the point in time when they have a viable business which actually makes money. And what we're going to do is, in this course, perhaps a bit unlike some of the other courses you've taken, is actually to view that process through the lens of an investor, not so much through the lens of the entrepreneur, although we're going to have speakers who come from the entrepreneurial side as well. And the reason for doing that is because actually to sort of understand, if you ever go down this route of trying to raise money from investors and to do your own venture, it's really valuable to know how they're thinking and what their experience has been and the sorts of issues that they think about. And so that's really why we do it this way. And the sort of objectives are to really sort of, you know, understand where the money comes from and the sources of finance for early stage ventures. It would be to experience the unique Silicon Valley ecosystem as it stands. All we can do is help you to understand that. But equally, you'll see when we get onto the timetable in a minute, if you've already had a look at it, that we are basically trying to run this as if it were in Silicon Valley with our Silicon Valley speakers, Alan Morgan, who's the co-teacher for this, who's based in Silicon Valley, and just trying to create the experience as much as we can in these exceptional circumstances. So that's why, again, another reason why we're sort of running it a bit late in the day UK time is because it enables us to video in speakers at the end of our day who are just waking up in California. And that's really one of the things we're trying to do. And then, you know, we're going to both evaluate the entrepreneurial business models, value early stage ventures, and look at the way that they're funded over various funding rounds. And then finally, to sort of understand the important aspects of a deal, the sort of legal terms as well. And the general philosophy I like to take is that you learn by sort of thinking, arguing, and practice. We'll try to do that as much as we can. And I should say that, you know, I'm very happy for people to participate in any way that works, you know, whether that's through just talking and asking questions, making points, putting your hand up, your digital hand up, as it were. I'll try to spot those. I can't always, because one of the things about Zoom is when you have your screen and you're sharing it, you get flashes up saying hand up and then they disappear. So I'll rely a bit on Kathy maybe to spot the people who put hands up and the like. Or just put things into chat. Again, I can't monitor it very easily all the time, but Kathy can help with that as well. So the basic sort of rules of engagement are sort of as much participation as possible in whatever way works, and we'll see what the modus operandi is for that. And then the final part, and this will become, I hope, clear a bit, you know, towards the end of the course, is that the assignment should actually be useful and help to reinforce the basic things that we covered in the course. And I say that because we're going to cover a lot rather quickly, and you don't necessarily get to fully understand it until you try it yourself. And that's really what the assignment is about. It's trying to give you a chance to go back over the course and cement into your mind some of the issues that we covered. And so I hope it should be useful. And from past experience, people say, it's reasonably tough, but actually it wasn't until I did it that I really understood it. And people do actually say they quite enjoy the assignment, or many of them tell me that. And since I don't know, we mark them completely anonymously, I don't think there's any reason why they should say that unless it were true. But I hope that'll be the case for you as well. So that's just a few sort of background information about it. In terms of making this work for us all, I think we have to realize it is challenging for everyone. We've tweaked the timetable a bit to have shorter sessions. We've got breaks fairly regularly, and typically a sort of half-hour break, except for in the late evening where we've got our guest speaker slots where we're going to run them straight after each other, because I think it's really important to have people there and not coming in later if possible. And we'll talk a little bit about those in a minute. But obviously, for those of you who can't necessarily, or maybe not you guys, but there may be some people taking the course, this is a bit early for them, it'll be available obviously on video as well. And we're going to run, some study groups and things like that as much as we can. And that's one area where I think, again, since March, we're going to try to put in a few more of those study groups so that you can work on things and I don't just end up talking all the time. And to do that, I'm going to sort of, to some extent, skate through some of this material and then give you a chance to discuss it yourselves. That's really the plan. The plus side, and this might surprise you, but actually, I think you're getting a better slate of guest speakers than we can typically get in Palo Alto. It is much easier to get people these days because they're stuck at home and they don't mind doing an hour here and there online. It's something different for them. So I think you can look and see that we've got a great set of speakers, and as I'll come on to just in just a second.
Tim, just before you go further, someone's saying in the chat that they've already looked at the assessment and they want to know, can it be unlocked now or do they have to wait?
I think it's better to wait because you've got plenty of time to do it. And I think that it would be better to have covered some of the material in terms of the language and the topics before you start delving into it. And I'd almost rather you spent your time in the next 3 days making sure you read the case material, getting prepared, looking over the stuff we're covering, rather than worrying too much about the assignment. I will cover the assignment at the end of on the Thursday, and I'll give you a chance to ask any questions about it then. So I think it's better to wait on that one. Okay, so in terms of the sort of structure of the course, it's basically organized in the way according to the sort of components that you see in a deal. So, in order for you to raise money for your entrepreneurial venture, you need to find investors, you need an idea and some entrepreneurs, you need a strategy to think about as to how you actually raise money, whether you go for broke or you try to retain as much ownership as you can. You need a valuation, a financial and legal structure, and you need a negotiation. Normally, when we run this course, we have a negotiation. I think that's challenging online, and we've sort of kept that bit out. And it might be, I know plans are afoot to try to create a sort of another part of this experience for you where maybe there is the option of going to California on an optional basis. And if that happens and we're lucky and we can do that, we might build that into it then as well. And then finally, you need an exit, because you need, these are entrepreneurial ventures are not funded forever. The investors at least need an exit, even if it's not an exit for you. And that's the structure of the course. And you can see that in the timetable, because we start off today looking at where the money comes from and how it's been for investors. which we'll do after the first break in session 2. And then in session 3, we'll sort of move to Alan. Alan is 8 hours behind us, so at 7:30 in the morning his time, he will talk about what it's like in Silicon Valley and the sort of key features of the Silicon Valley ecosystem. Will be the sort of third session of the day. And then we go into each day we have these sorts of 2 speaker slots. And so you'll see here we've got a fantastic lineup. We've got Cal Henderson from Slack, who's one of the founders of Slack, who's actually a Brit, and will be talking in the first session. And then we'll do a case study, and you'll see both the case studies we're using. Actually, we have the founders who are going to participate in this for the first time. Actually, we've never had this before. Jeff Lewis has participated a few times, but he will be talking. We'll be doing the guidebook case with him. And indeed, the case tomorrow on Fabulous we'll be doing with Jason Goldberg, who is the entrepreneur behind that as well. But that's the first day. And then the second day, we move on to valuation and sort of the sort of importance of the entrepreneur and the reason why entrepreneurs are as important as the idea, which is what the first 3 sessions are covering. Then we'll go to Kevin Laws, who's the CEO of AngelList, which is the largest angel funding network, and most ventures get started up by getting funded by angels. And I would encourage you, sometime this evening or during session to have a little look at AngelList if you've never looked at it before, because it is the dominant angel funding network, and it's a very interesting. You can go online to their website and have a look around to see what they do. And then the second session tomorrow will be in the evening, or in evening our time, will be Marianne Saenko, who is what is a young female venture capitalist, and that is quite rare in Silicon Valley. In fact, it's a matter of some dispute as to how few female entrepreneurs and how many female founders there are. And so she has founded recently with a very experienced venture capitalist, the Future Ventures, and she'll be talking a bit about that process. And I think you'll find her a very interesting speaker. We've had her once before, and she's not as it were, a huge name in terms of having been around for the last 30 years, but she has a very interesting and different perspective. Then on the Wednesday, we move to the sort of financial and legal structuring part on that sort of hierarchy of topics. And we have 2 complete sort of, the titans of the industry. Reid Hoffman, who is the founder of LinkedIn and is probably one of the most famous entrepreneur investors in Silicon Valley, and he's now both an entrepreneur and an investor because he's actually a partner at Greylock, but he's also a board member of Microsoft, who bought LinkedIn, and he's been involved in virtually every so many meaningful ventures in the Silicon Valley. So we're lucky to have him. And then we've got the Brooke Byers, who's one of the founders of Kleiner Perkins Caulfield Byers, which is probably the best known venture capital firm. And he's one of the most famous biotech investors in the world, which is fantastic to have him. And then on the final day, we finish early and we return to valuation and terms, if you like, on the first session. Then we look at exit routes, and then we wrap up. And I should say, in terms of the timetable, I'm going to try to stick as much as possible to the timetable, but to some extent, it's a function of you, how much discussion we have, how the sorts of things you get interested about or need more explanation on. All I'll say is that we will wrap up by the end, and it might be that the end of session 3 each day, there's a bit left over. Sometimes there is. Don't worry about that. We will get to the end on time. So let me stop there and just check if anybody's got any questions or any points you want to raise about the timetable. Otherwise, we'll get on.
I think the other thing, Tim, is that we want to give people as much opportunity as possible to ask the guest speakers questions. So, yeah. And that worked so well last time, whereas sometimes face-to-face, you tend to find that the 3 amigos, Tim, Alan and I, sort of dominate the conversation. That hasn't happened on Zoom, and we've been able to get a lot more questions for the guest speakers from the class. So when they're here, you know, we'll make sure we call you, and the chat function means that, you know, we can see the questions coming up and then we can bring you into the conversation. And at that point, you know, try and have your screens on so that we can see your faces when the guest speakers are here.
Yeah, and just another point, you know, some of these people are very well known, and they're quite sensitive about social media and tweeting and things like that. So please keep these sessions here confidential. Some of them are board members of public companies as well, you know, so Slack is a public company, Microsoft's a public company, which, you know, so you just, please be careful, like, don't do it. In other words, when I say be careful, do not tweet, do not do things like that. This is sort of Chatham House rules. These are, you can ask any question and they will be very forthright and open, but only if they don't feel like they're being screenshotted or videoed, or, I mean, we're videoing the sessions, but they ask questions about how they're going to be made available. So please respect that, because these are great speakers, but we'll lose them if there's any thought that they're, you know, suddenly is flashing up that, you know, X just said something, and so please don't tweet or anything like that. It's a very sensitive issue. Okay, so if there's no other questions, I will just talk very briefly about the assignment, which is going to be, it's a presentation you'll have to do, which is in a PowerPoint presentation, and it'll be basically a evaluation of an early stage venture. You'll be working as an associate at a venture capital firm, and you'll have to be doing an evaluation of a venture, and you have to do all these things. And I'll give you a briefing on that on Thursday. But it'll be, as I say, a presentation. It's not an essay or anything like that. You just have to do a PowerPoint presentation of no more than 25 slides. Okay, so maybe we'll park that until Thursday, and then I'll come back to it at that stage. In terms of, maybe I'll get into the sort of topic, because I'm aware that we've got to move reasonably rapidly through the material, but essentially what I want to do is start off by giving you a sort of introduction to what we're talking about and why it's different from normal finance that you've done, because, you know, many moons ago you did business finance and now we're doing entrepreneurial finance. And the difference is that we're dealing here with very high risk early stage ventures, where, you know, the sort of main area we're looking at is where you've got an entrepreneur who hasn't got enough money to actually see their enterprise through. So we're not going to really look at like low cost, low growth type of, you know, sort of self-employment things, like I want to set up a cappuccino bar in Oxford. You know, that's not the sort of thing you raise angel and venture capital funding for. It's the sort of venture that can scale very rapidly and become potentially extremely valuable. And it's sort of one of the biggest questions, and one of the things that I think a lot of entrepreneurs struggle with, and we'll see in some of the material of this course, is how fast you go for growth, and how fast do you raise money to try to grow, and that's what or the extent to which you bootstrap yourself to available funds. Bootstrapping means, you know, you sort of only grow as you generate cash to sort of, you reinvest it in the business, but you're sort of very dependent upon the cash. And one of the reasons for looking at that as an issue here is that many of you will be aware that Silicon Valley is really associated with this view that you should dash for growth, and, you know, it's all about backing the winners, and you back them big and you give them huge funding rounds, and you say go off and become the dominant player in your particular segment, whatever that is. And you worry much less about cash flow until later on in the day. And this ebbs and flows, and I don't want to overstate how dominant that view is, because at the moment we're probably in we're sort of ebbing a bit on that, with coronavirus and cash flow becoming quite difficult for a lot of ventures. But it is still one of the most interesting aspects of the Silicon Valley way of doing venture funding, which doesn't exist in many other countries. And so we're going to really explore that a bit over the next couple of days. And I think the other thing is that I would love to say that, you know, everything is about money, but actually the venture capitalists who are involved here are not just all about money. They have huge networks, experience, can actually help to mentor the entrepreneurs, to give advice and things like that. And actually, and very often, your probability of success is very much equated with whether or not who's funding you. So, you know, if you're given the choice between taking money from Kleiner Perkins or Jenkinson Ventures, you know, I recommend you take Kleiner Perkins, because that is likely to mean that other people will immediately be interested in you. As soon as they know that Kleiner Perkins are your first stage investor, you'll find it a lot easier to find a second stage investor, I can assure you. And so it actually is not just about money. It's about the reputation and even the services that they provide. So many of these companies are not just providing you with money, but will say, don't worry about getting an accountant in yet. Focus on your business, and we've got an accounts department. They'll help you through to the stage where you've got to have your own, or a design department or something like that. They're actually employing a broader range of professional services, which they sort of make available to the early stage ventures. So there are a few differences there, that it's not just about funding an existing business which has an established cash flow. You just don't know whether it's going to succeed or not. And the second reason why it's important is because some of the things that we all know and love were really funded this way. So a lot of the services that we all now rely on were all came out of this system, including most of the stuff that we're now using, like Zoom or Apple, or all these sorts of things. But it actually is all these things were actually funded and came about through successful venture capital fundraising. And the one thing you won't pick up there is, what the hell is Verivox? And that was my entry into this whole world, because actually, even though I'm a career academic, one of my first experiences in fact, my very first experiences of entrepreneurial ventures and finance was when I was asked by some former students to go on the board in the 1990s of a company that was one of the very first companies that was trying to do sort of utility switching. So switching your telephone, switching electricity, switching gas to a new provider. And they were an internet-based system, very early in that, one of the very first doing that. And for the next 10 years, I was actually on the board of that through very many near-death experiences. And it eventually came out, and if you Google them, you'll find they still exist, and they're actually the dominant player in Germany in terms of utility switching. And so I learned an awful lot through that, which I had never learned as an academic. And eventually, a few years later, I started doing research on it, and then a few years after that, I started teaching. But it was actually my experience of this actually came through being on the board of this and subsequent companies which I've been on, and I've learned a lot through that whole experience. So that's the one that you won't recognize there, unless I don't know whether there's any Germans in the house, let alone any Germans who've switched their utility services. If they have, maybe there's some consumers of Verivox there, but otherwise I would assume you'd never heard of it. But those are success stories. But it's worth noting a couple of other things. Look at this. This is a chart which I pulled together for last year's course, the one in July, the July 2019. And this was the valuations at that time. In fact, this was in February 2019, of the 10 most valuable VC-backed US companies. And you look down those, you see the valuation. So, Uber in February last year was worth 72 billion. Well, how much now? Maybe double figures, billion, but unclear, right? WeWork, okay, so still up in the air. And to be honest, we had a huge discussion on that course about WeWork. It was mostly about WeWork, and we were saying, we don't think it can possibly be worth this much money. Kathy, you'll agree, we sort of said that. And so that was, and Joule, again, hugely valued a year ago. So these are risky. Even the ones that survive, investors were putting money in at extremely high valuations, and some of those look extremely unlikely that they will actually come true.
Actually, WeWork is still predicting happy times ahead.
True. I saw that in the Financial Times this morning.
was in today, wasn't it?
Whether anybody would put money in at a valuation of anywhere near 47 billion is a very sort of.
It was a good try.
A good try. And if you look at the size of that funding round, it wasn't like chicken feed they raised at that value. They raised $5 billion at $47 billion valuation. This is almost brought down SoftBank as a sort of investment. So if you look down these, there are some who have gone, who've gone public by now. So Lyft's gone public. Palantir is likely to go public quite soon in the next, I think they've filed confidentially. Or if you look down the 11 through 20s, you see Slack there, they've gone public. So there's been some very interesting developments here. But these are, these were the companies that everybody was talking about a year ago, and just making the point that there is huge risk and uncertainty about whether the companies will succeed, and if they do, how much they'll be worth. So those are some thoughts on the type of company we're talking about. But even when we're looking at those sorts of successes, or at least successes to some investors, don't forget that for every success, there are a huge number of failures. I don't know whether any of you remember these companies, but these are companies that essentially were funded by venture capital and went bust. And the numbers underneath them are the amount of venture capital they took down with them. So, very early one, very famous one was Webvan. At the time that Webvan went bust, it had funding of $275 million that went to precisely zero. Or a lot of these other ones like BP or Rudio, these take down prodigious sums of money when they fail. So we're all very aware of the successes, but people don't like talking about their failures very much, so you don't see much of it in the press. But remember that they are there. This is far from low risk. This is extremely high risk in terms of the investors, and that's why if you go along and speak to an investor, they will be thinking, are you going to take my money to zero, or are you going to make me a star? Are you going to make me justify to my investors why they should give me some more money to invest? And so it's very sort of, it's not exactly 0 and 1, but it's a sort of hit it out the park model. You have lots of failures, and then you have a few that you make, eye-watering sums of money on, might be 100 or even 1,000 times your money on a few of them, and you earn your reputation on that. And that's what the investor's looking for, is could you be that next 100 times my money deal? It's not saying, am I going to get twice my money back at the end of it? If they think they'll get twice their money back, they won't invest. Now I see there's a flash in my in the top of my screen. Are there any questions coming in there, Kathy? Sorry, I ought to.
I'm just looking, actually. I think Fabian was just saying something. So.
Well, you've been very quiet, so maybe I should.
Yeah, Fabian, in the VC environment, what's the success ratio? Fabian, do you want to come in and sort of say a bit more?
Yeah, sure. So you mentioned there is a lot of amount of failure, and we should not forget about it, and it's a high risk. But for example, in a VC fund, in a portfolio of 10 companies or 50 companies, what is the ratio of successful? How many are going as a unicorns or moonshots? So
yeah, so yeah. Thank you for lining that up for me, because I don't think it's quite the next one, but can I just nip forward too? This is, I think, entirely trying to ask you a question. So this is splitting up. I got this data from Stepstone, who are one of the advisors to institutional investors in venture capital. And that's the question that a lot of institutional, if you're a pension fund, you ask that question all the time, like, how much of my money am I going to lose? And this splits it up into 3 different periods, if you like: the pre-dot-com bubble, 90 to 99, then the sort of what I'm going to call the lost decade, which was 2000 to 2009, where returns were not very good, and then the more recent period. And the star here, or the diamonds, are the loss ratios. By loss ratio, that means sort of, in this case, sort of like basically losing all your money. So the answer to the question is probably 50% of the deals you lose all your money on. And then, you make your money in terms of the returns, in terms of the the sort of, these are at the fund level returns, I should say. So these are the sorts of IRRs that you make on the funds, but the loss ratio is the loss within the fund of the number of investments that you basically lose all your money on. So as a basic rule of thumb, you might say you lose your money on 50% of all of it. And then you get, you know, some return on maybe 40% of the deals, and you make serious money on maybe 10% of the deals if you're lucky.
I think Brendan's got a question which I don't know that that we'll be able to answer, but perhaps our guest speakers will, about COVID. Brendan, do you want to just sort of speak up, because I think it's good to get us all talking.
Sure. So I act as an introducer for a lot of angel investors in Europe, matching startups with deals, and I have seen the behavior in Europe especially quieten down quite a lot in terms of what they're willing to accept pre-COVID versus post-COVID. I was just wondering if that has been the same in the US, or is Silicon Valley still as bullish as it was pre-COVID?
Yeah, I think we should ask that question to Kevin Laws. He's the guy with all the data because he runs AngelList. So I think we'll park that one. I don't know the answer to the question. My strong suspicion is it's probably slowed down. But on the other hand, you could say it's a great time to invest, right? Because the valuations might be a bit lower. Yeah. But shall we park? It's a good question. Maybe we should park that.
And the difference between VCs and angels, so the VCs are still very open to do more deals because they have to get stuff done over here. But I've seen the angels very much quiet. So
yeah, I think that's right. Because in a way, funds, the venture capital funds, have funds that they have to deploy. Right, so they're always in the market, whereas at angels, it's basically their own money, and they can decide not to spend their money, not to invest for a year or two, if they want. So I wouldn't surprise me if there was a difference between them. But I think that's a great question to ask Kevin, and we should do that. I think. Just to go back one stage, if you like, you know, we've sort of touched some of this, but the realities of entrepreneurial finance are that it's really hard to get money, really hard. So if you do get funded, you've done extremely well. And it's actually hard to even get to first base. And Alan's quite good at sort of giving advice on how to get to first base with a venture capitalist or an angel investor. And so we'll you know, it's a good thing to ask him there. I think that navigating your way through the system is an essential skill. You know, you can't just sit in your office and spray emails out and say, will you fund me? It has to be a bit more. There's a bit more networking and subtlety involved in that. And I think it's also true that, you know, the jockey, we're going to use this analogy of the horse and the jockey. The jockey is the entrepreneur and the horse is the idea. And the jockey matters as much or probably more so than the horse. In other words, whether they fund you, they're going to fund you and your idea, not just the idea. You could say, well, you know, I'm not particularly sort of good at selling myself, but, you know, the idea is really good. Generally, that's quite hard to get funded. They want to fund people, actually. And that's partly because we put here, stretching the analogy a bit, but horses become lame and have to be shot. In other words, the idea may not turn out to be the right idea. And in entrepreneurial finance, this is called a pivot, it's given an official name. And pivots happen all the time. And we will see tomorrow all about pivots. And because pivots happen, the venture capitalists are not necessarily super sort of, you know, wedded to the particular idea. But if they know the idea is going to change in 30–40% of the cases, you've got to have faith in the entrepreneur who's actually going to pivot with you. So it really matters, I think. And indeed, the fact that the idea keeps changing almost makes investing in early stage ventures a bit like an option value. You don't quite know what's going to happen, but, you know, in 6 months' time, you may find that original idea isn't working, but it's proved to you that another idea is really, you know, potentially promising. And so, you know, some people think of it as a bit like you know, buying options. You put a small amount of money on the table, and then you might be able to get, you know, more in the future when you learn more, have more information. As I say here, I've used 40–50% of the ventures really do basically fail and you lose all your money. And so it's all really about this very non-normally distributed returns where, you know, you get lots of zeros and then you get some returns which are way over on the right hand side where you're making 10, 50, 100, 1,000 times your money. And so in some ways you have to lay a lot of bets in order to get enough of those chances to get your 100 times return. And that's the way I think a lot of angel investors think about this, is that they have to be doing a deal a month, or, you know, 6, or, you know, deal every other month. And then they'll have a stock of companies they'll be investing in. And some of them, and they double down on the ones that are doing well. So that's, I think, the way that it works in practice. Those are some facts about the area. You know, where does the money actually come from? Well, it comes from essentially 5 different groups of people. Most ventures start by being funded by individuals themselves to some extent. The so-called friends, family, and fools come in. So, you know, people who will help support you. Increasingly in the sort of informal sector, there's crowdfunding as well, which is a bit like having family and friends, in my view. One level up from that is third-party angel investors, if you like, the individuals who might chip in 100, 50, 100, $200,000, pounds, euros, whatever. And then you have venture capital funds who tend to be putting in, you know, 500,000, 1 million, 10 million, 50 million. You also have corporate venture capital funds who are people like Google Ventures, or now called, who aren't allowed to be called Google Ventures, called GV now, but Google Ventures, Intel Ventures, Facebook Ventures, all these people have their own corporate venture capital arm. They have certain slightly different pros and cons with them. Many people don't like taking their money because they worry about intellectual property leakage and things like that. And then you have the 5th basic group is essentially what I've called here new private direct investors, which is people like mutual funds, hedge funds, sovereign wealth funds, who are now increasingly putting money in themselves. And why is that? And I think this is the most interesting thing that's changed in the last decade, is you're seeing these early stage ventures stay private for so much longer. And if you just go back for a minute to the slide which I showed here in terms of when they were funded, if you look down the founding year, look at when those companies were founded. They're founded like 10 years ago, sometimes 15 years ago. In fact, in Epic's case, you know, you've got something that was funded close to 20 years ago and they're still private. And what that's showing you is that they can raise prodigious amounts of money in the private market. So when, you know, Uber or WeWork are raising money, they're sometimes raising it from mutual funds who have got big, deep pockets, or hedge funds who will come in and put in 500 million or, you know, that sort of sums of money. And that sort of funding was never available before. It used to be you had to do an IPO to do that. And these private direct investors are now, you know, have made a really big difference to the system. And it's meaning that companies stay private for a lot longer. So if you want to stake in early stage businesses, you know, you're going to have to, that people are having to think a bit about how they do that. And that's why some of these investors are actually coming in at this stage and doing that.
So Tim, we just got, Burley wanted to ask a question about multi-stage investments.
Sure.
Do you want to just go straight ahead?
Yeah, Tim, just from your previous slide, we noticed that in last 10 years, the multi-stage investors, they seem to have a higher failure rate than angel investors.
Mm.
That is very unusual from my point. Does that mean the angel investor has good exit strategy, or they exit on the right time, or what's caused that?
Yeah, I mean, some of this data isn't necessarily as intuitive as you might think, insofar as you've got a higher loss, you've got a higher loss ratio for the early stage, seed and early stage funds, but a higher return, right? And that's telling you that you're losing money on a lot more deals, but the returns that do come good are actually very good, you know. And so, but you wouldn't, so these things can flip around, you know. Sometimes you get that the multi-stage fund you'd think the multi-stage fund should be like in between the two, but actually all it's really showing you is that would be true if this was a sort of normal distribution. But it's not a normal distribution, so unfortunately the average of two things, if you're doing the average of two things, is not necessarily the same. So it's it certainly is surprising to some extent that, you know, you're sort of some of these you seem to be taking higher risk and getting lower return, and that is for some of these occasions. These are the ex post returns, so you know what actually happened, you know, so for example, if you look at the middle block, you know, you've got the early stage, the seed stage funds having very high loss ratios and very low returns. Doesn't really make sense. Like, why would you do that? Well, the answer is if you'd known beforehand, you wouldn't do it, but that was the outturn. So, you know, these give you a bit of an indication, but they're not what people expected when they went into it. I think when they go into it, you think the seed stage will be the highest risk and should be the highest return, and the late stage funds should have a lower risk and a lower return. And whereas actually here, the late stage funds are doing better than the early stage funds, which is a bit counterintuitive, but it sometimes works that way, I would say. Hope that answers it. But just in terms of other sort of, you know, facts that it's worth bearing in mind, especially when we're talking about Silicon Valley, is that what I've done here is pulled out the sort of long-term history of funding for venture capital in the US. And I've used the US because you can get the longest consistent measure, and also because we're sort of in a Silicon Valley sort of mindset. And you'll see an enormous growth in venture capital up until the dot-com bubble burst in about 2000. $100 billion was raised for funds which were raised in 2000 to invest in venture capital. That then just dropped off a cliff because the returns, once the dot-com bubble burst, there were a lot of losses at that stage. And so you'll see in 2002 that barely anything was raised for venture capital. And there's been these waves. You see it growing up until the financial crisis, and then it went down again, and it's growing up till COVID, and maybe it will go down again. But we're nowhere near where we were in 2000. Nowhere near, and never have recovered to that much. And as we'll see in the session after the break, the returns on that big chunk of money were really bad. And that's one of the things which actually sort of is a legacy of the dot-com bubble, which took a long time to work out. I think it now is worked through the system, but for a decade it wasn't really through the system. So
what, Imane, so do you want to speak up? You've got a question about the horse and jockey.
Yeah.
Yeah. I was wondering what, oh, you're sounding a little bit like Darth Vader there.
Yes.
Can you hear me okay now? Not really. Tell you what, I'll say your question for you. So you were saying what would a perfect jockey look like? And then perhaps if your sound comes back, you can engage then.
Well, I think that's a great question for Alan. I think maybe we'll park that for Alan, because I think he's the one who invests in jockeys all the time. So let's park that one, because I think that's a great question. But I know the answer will probably be somebody who successfully launched a previous venture, but that's a sort of chicken and egg problem. But that,
or someone who earns the investor a lot of money, Tim.
That's true. So but let's park that one for Alan, if you don't mind.
Just a question from me. Does this also include the Vision Fund?
This one doesn't, because these are raised by standard venture capital funds which have a closed-end structure to them, which I'll come on to what that means after the break. But yeah, the Vision Fund, for those of you who don't know, is SoftBank raised this $100 billion fund to invest in venture capital and completely sort of change the nature of the way that investing was happening in early stage ventures. we've been teaching this course through the Vision Fund, and that was, I think, raised in 2018. So it's not there in the data because it would be way off the scale. But these are just venture capital, traditional venture capital funds, which have a sort of fixed life to them and have a normal relationship, whereas the Vision Fund is a very weird vehicle, which we can discuss a little bit, but it's not a standard vehicle at all.
Yeah, because like the size of it completely makes this graph go offbeat and beyond the 2000 levels, right?
Yeah, and indeed, if you think about what they spend their money on, they're not really like a typical venture capital fund. They're sort of a late stage, almost getting into a sort of holding company structure or a sort of private equity structure. Because after all, they spent about, what was it, 20, 30 billion of the Vision Fund went on buying AIM, the microprocessor, no, what's it called? The microprocessor company in the UK. No,
AMD.
Yes, that's right, exactly.
26.2 billion, yeah.
Yeah, they're taking huge bets. So I say it's almost like a holding company structure because they're buying established businesses and then sort of trying to glue them together. And they're a little bit different, I would say.
But they did actually invest in WeWork, which cost them a lot of money, which it was a venture capital investment.
It was, but then again, you see what they did. They were putting debt in, they were putting equity in, they were basically
right.
Now they essentially control the company. I mean, I guess they own a majority of the equity now, and so, or certainly own a majority of the board seats. So they're a bit different from a normal fund. Having said that, they are a true disruptor. None of us really know quite how to think of the Vision Fund because they are so big, and but they were. And they were coming in and they were, laying also quite a few smaller bets, which for them might be like 100 million. For them is a small bet because they are $100 billion fund. So they are very much a sort of interesting new player. I wouldn't put that, they don't enter into this data because I'm trying to compare sort of like with like, which is, if you like, the standard sort of fund run by an established venture capital partnership, as it were.
Thank you.
Let me just give you a few other facts before we sort of, I'll break and take any final questions. But let me give you, again, a few facts about deals. So, and you can look back at these maybe, after at some point later, but you'll see that here on the top chart, we're just sort of showing the number of deals in the line and the deal value, which is sort of looking at how much is invested in early stage businesses. And there it's you're seeing 10,000 deals being done in the US in recent years recently, these numbers sort of do include the Vision Fund because you see the big jump there about the time it was raised. You see in terms of the deal count, or the deal in terms of the amount invested, the deal count on the left hand side is how big a deal is typically, how much is the value of the company at the point in, or the value of the amount that the company at the point in time you're going into it. And here, you see that a lot of the funds are going into quite small deals. So, maybe 20% of the 20 to 30% of the deals are valued at less than $1 million in terms of the amount of money going in. But in terms of the amount invested, you only need one $50 million deal and you've got a big chunk of money. So you can see there that the majority of the money goes into the deals which are much larger, as you'd expect. Same is sort of true on the angel side as well, where you see, generally speaking, as you'd expect, the deals are much smaller, but you're talking about $100,000, $200,000 being put into deals quite regularly on that side. I want to just give you a sense of the valuation side as well. I'll come back to that in just a second. But the valuation side is, I think, quite interesting because many people say, sort of how much do you raise at each deal, and how much you valued at. And if you look here at the bottom graph, the pre-money valuation, in other words, this is the value of the company as they go and pitch it to the venture capitalist before they've put any money into it, if you like. And you'll see there that, you know, your average angel and seed round, you've got a valuation in single-digit millions of dollars. So, you know, it might be $7-8 million would be a typical deal, or the value of the company. And then you might raise $1 million. So that tells you, the simple mathematics of that are that if you raise $1 million and you're say valued at 9 million to keep the maths easy, then your post-money valuation is 10 million. In other words, you valued the idea at 9, you raise $1 million, and then it's got a post-money value of 10 million. And so if you raise $1 million on that value, you've given up 10% of the company. And that is perhaps on the low side, but you might give up 10, 15%, 20% of the company on a given funding round. And then as you go through the sort of early stage VC rounds, they might be looking for companies that are worth like 25 million, and they might put in 5 or 6 million at that point in time. So again, you might then be doing, giving up 20% of the equity at that point in time, because again, to keep the math simple, a 25 million pre-money valuation, you raise 5 million or 6 million, what makes it easy. 24 and 6 makes it easier. So 6 is a 30 million post-money value, and you're giving up 20% of the company. And so there are some sort of facts that I think are typical in this sort of US market as to how valuation progresses. And I see some people, I'm sure you didn't do this in your entrepreneurship projects, but some people I have come along when I used to supervise them say, oh yeah, we think we want to raise, you know, $10 million on a $100 million valuation, you know, and this is a sort of early stage angel round. That doesn't really happen very much, hardly at all. These are medians, so you do get some really exceptional ideas, but not really very many of them. So those are just a few sort of facts about the valuation and the sizes. I wanted to make one other thing about the nature of angels, you know, and that I think that increasingly over time, angels have become encouraged for tax reasons and things like that, you know, you're wanting to encourage people to do angel investing. And indeed, in many countries, there are quite big tax advantages of given over to angels. So, you know, in the UK, for example, you can have huge tax advantages at investing in early stage businesses. You can sort of write off your investment, 30% of your investment up front for the enterprise investment scheme. And then you don't get any losses you can offset against capital gains and things like that. And indeed, this has sort of encouraged some people to set up whole structures based on that, which are essentially allowing people to invest. And also you see crowdfunding in this framework as well, because crowdfunding is essentially individuals being able to invest in early stage ventures. So that's really changed over the years. The other sort of introductory factor I wanted to make to draw out, and I've sort of mentioned it a few times, but just to be clear, is entrepreneurial finance is about raising finance several times. It's not a one-shot game. And so in terms of terminology and who's doing what, you know, people think of the concept stage where you're basically having to fund it yourself, make sure it sort of makes sense, come up with a pitch deck, you know, maybe come up with a prototype or something like that. And that's the sort of early stage without any outside money. And then you tend to involve the seed stage, is what they call where the angel investors get involved and they sort of seeding the idea. And then you get the early stage investors, which is sort of Series A, it's typically called, and they're always called Series A, B, C, etc. Then the later stages would have, and that's when the venture capitalists come in. But the later stages, B, C, D, E, you'll see some of our examples, they go up to like H, and you get a different range of people coming in there. You get some VCs follow on a couple of rounds and they do a B and a C, and then they'll stop. And then you get corporate venture capitalists coming in, or you get mutual funds coming in. And we'll see a whole different range of people coming in over time as you go through those stages. So those are just a few sort of facts and sort of figures. If you also, just as a sort of final look at how what the different funds and the different names in this area, how they think about it. So these are some of the biggest name venture capital funds out there. If you got any one of these investing in your business, you would have done exceptionally well. These are the sort of some of the really top funds. And you'll see here on the left hand side, you see that the amount they'll put into a Series A deal typically, and then on the right hand side how much they'll put into a Series B. So Series A would be a sort of early stage deal for them, and indeed they're putting in that the typical deal size. This wouldn't necessarily be them putting in all the money. They might be one of 2 or 3 funds who put in money, but you'll see it's typically like 10, 15, 20 million. On the bigger side, you might have 2 or 3 people coming in, so they're making a $5 million bet or something like that. And when you talk about, I do like late stage venture capital, it's more like 20, 30, 40 million being put in. And again, it might be split between investors. So very often, sometimes when you hear of these incredible returns, that's because, Axel, for example, were big investors in Facebook, and they probably only put in like $10 million and they got out, 2 billion or something at the end of it. And so you can end up with these absolutely astronomical returns. They don't keep investing all the way through the funding rounds. You might say, I've invested in a seed stage, an A and a B, that's enough for me. I think this is going to succeed. Let somebody else fund it, because they're going to make lower returns, right? The people who make the really high returns are likely to be the ones in the early stages. And so that's the sort of way they do it. Even these big name firms, they won't follow on forever and do all the funding. So anyway, that's a brief summary of what we're going to deal with. I won't go through the summary. I'll let you look at that, but I did want to give you a chance to ask any questions you've got at this time. Very strangely, and Kathy will say this is extremely strange, we are on time. So I'm going to carry on and take Randy's question and any other that might come along. So Randy, over to you.
Hang on, Tim, you're just looking for a compliment, because in general, you're not too bad at going over. How does that sound like a compliment?
I guess that's as good as it gets for the time being. So, well, Randy, over to you.
Tim, good summary. I'm curious though, as you talk about those seed stage investors, and as they stop and they don't participate in follow-on rounds, then they're facing dilution. Do they go into it thinking, okay, here's the range at which I want to have an ownership position now and through the dilution phases? Yeah,
they do, and they absolutely expect to be diluted, and that's because there's good and there's bad dilution in life. Good dilution is, I've put in a small amount of money into the company. I've got a meaningful stake up front, maybe 10% of the company for like $100,000. And after that, I know that my 10% stake is going to go down to something much, much smaller than that, 1% or 0.5%. But if it really succeeds, I'm going to own 0.5% of a multi-billion-dollar company. And that will be absolutely fine, because I haven't put any more money in at that stage. So that is absolutely fine. If you own a slither of the next Facebook, that's when you make 100,000 times your money. And so they don't care about dilution that way. People care about dilution when the value is going down, in truth. So you think, okay, I put in $100,000 for 10% of the company, and the next round is at half the value, and I'm going to raise the next 100,000, I'm going to get seriously diluted, because they're going to have to issue all those new shares to raise the next 100,000. And then dilution kills you, because your stake is going down in value, not just because the value's gone down of what you put in, but you're being diluted away as well. So really, dilution is something where there's good and there's bad, but angel investors go in expecting to be diluted.
Okay, thank you.
I think Brendan's got a question as well about investors. Brendan?
Sorry, just had to unmute myself. So the question, what I'm seeing in the UK, I was just wondering if it's happening in the US. I'm seeing more consortium led deals happening, especially with angel investors. So in the past, I would have probably seen an angel probably put in the whole amount himself, or one or two, but I'm seeing like almost consortiums where they get together and they'll say, I'll take 5%, 2% if they find something. Is that happening in the US at all?
Yeah,
you know?
hugely. And one of the reasons for that is AngelList, because AngelList is basically single deal venture capital funds for angel investors. So if I want to invest in your company, I go onto AngelList. I'm a lead on AngelList. Anybody in this class could then co-invest alongside me, and I would be the front guy for it, and everybody could co-invest alongside me in a very simple automated structure where all the legal documentation and everything is generated essentially in real time. And that's meant syndication of angel deals is now the norm in the US, and it's much less, you know, well, very early stage deals, which might be $50,000, I think you'd still get an angel going in there writing the check, one angel. But once you start getting up to a couple of $100,000, people are using this sort of technology to syndicate. And Kevin Laws, we should ask him that question, because he's got some very interesting sort of, the history of AngelList is fascinating, because it basically almost became banned because it almost became like a broker dealer. It's almost like trying to sell an IPO to lots of people. You know, you're a bit like an investment bank, and they had to convince the US authorities to let them proceed with their technology, you know, because there was a bit of a nuance here about if you're a platform, do you become a bit like a dealer? And so the short answer to your question is yes, it's becoming much more normal to have really quite large groups of angel investors syndicating together, and it's become super easy to do it as well.
Yeah, because I mean, I'm not seeing that. Maybe I'm missing something, but I haven't seen the technology side in the UK. I've seen what I would have seen individuals in the past are now obviously coming together more formally and having pitches done where they'll take a nominated.
Yeah.
But it's not as automated as you mentioned about this AngelList.
I think it will come. I think a lot of places are a little bit backward on this in terms of, and there are complex legal issues about creating documentation, being able to sign it, having sort of, you know, all the, you don't want to have 100 angel investors where one of them could hold up the next funding round, right? That's absolutely got to be, you've got to have this sort of lead investor who is going to be the person who can sign the documents, do the deal, and everybody else has to be sort of, in some ways, agree that they are the lead. And once you get that, it works.
Sorry, then how does it work? Does that then, do they, once they agree that they're going to be part of the deal, do they then subordinate their rights on it? How does it run through?
Yeah, it'll tend to be a sort of nominee account where you agree that the person who is leading this can make the decisions.
Okay, now that makes sense. Okay, I haven't seen that yet.
Yeah, no, that's right. But again, these sorts of questions are really interesting, and the question about whether, for example, AngelList can operate in the UK is an interesting question, because of regulation is quite restrictive on these things.
Okay, now, no, that's very helpful. Thank you.
Now, what I'm going to do, I think, given that we started off well, so why don't we continue along this route? What I'm going to do is let's take a break now and come back at 1:30. Sorry, that's only 23 minutes from now. But if for us in the UK, we'll get some lunch. For those of you in the West Coast or the East Coast of the US, get some breakfast. And then I'll start off the next session. If anybody's got any questions about what we've just covered, then we'll deal with them at the start of the next session. For this next session, I'm also going to put you in study groups and get you to work with some fund-based returns. So there is a file on the Canvas site that you might just want to download. It's a little spreadsheet with some real data in. So we're going to work on that in the next. The session 2 is always an hour and a half, as you'll note, and they're good times for us to do study group sessions as well. Okay, so that's the plan. Would you like me to just leave this open so that people can chat if they want to? I know that was something that the March group did, but if you want me to leave it open, you can go on to mute and turn your video off if you don't want to talk. And but if that's sort of some way that you can catch up socially, maybe I'll leave it on and see if it works. If none of you are using it, then we'll stop it. But we'll stop recording at this point in time. And while I still have you all on screen, rather than, you know, when you share your screen, you only get to see like 2 or 3 of you, so I sort of lose you all. I feel more connected at this point before, so I can actually see you. But are there any questions or points anyone had to make, or questions about any of the material we went over?
Yeah. Hi, Tim. I have a question about crowdfunding. How crowdfunding is categorized? Is a VC? Is an angel fund? And is any advantage to go for crowdfunding instead of VCs? Or what is your view on that? Yeah,
I mean, crowdfunding is what I would call sort of retail level angel investing, insofar as you can, it's a way of syndicating very small sums of money being raised through people like all of us, you know, where you can put in $100 into a venture and the like. And I think it's, you know, I think it's the sort of thing where if you can avoid it and get an angel investor interested, I would go that route, because I think that there's a sort of signaling aspect to it, that except if you are a very strong retail brand already, I think it would be better to have an angel who can very often help get you to the next stage, because a good angel investor will be your introduction agent to your venture capital fund. Whereas crowdfunding, I think, has been most successful when it's been done by organizations which are already have a very strong retail sort of following. Could be like, we've seen a number of breweries do it. We've seen Hotel Chocolat do it in the UK. Places like that where people have an affinity to it, and it's sort of building, part of building that affinity. But if you're doing, you know, a sort of software as a service, you know, nobody really has affinity to that. You know, you should be thinking of it as an investment. And I think it's generally better to go with angels if you can. And I say that with a heavy heart, because Jeff Lynn, who's the founder of Cedars in the UK, was an SBS alumnus. So he's their chairman now and was a founder. But I still think that you'd be better off going with a professional angel investor if you could.
Okay, thanks.
Yeah. Any other questions anyone's got on what we did before? Or in general? I'm happy to answer any general questions. If not, then I guess we will go on to the returns and the investor side, which I think is the next thing on the list. So where does the money actually come from? So let me just find my right thing to share. Sorry, I've just got to get it up. Here we go. Got too many windows open, sorry.
Tim, I don't know if you want your own mic up or if you need to just be a bit closer to the screen, because you're not terribly...
I'm not sounding too good?
You're sounding wonderful, but a little more fortissimo might be good.
Okay, that sounds fine. Sorry, I'm just having a technical glitch insofar as I'm just trying to find I've got a lot of windows open, but it's not seeming to pick up the one I want.
While you're doing that, Tim, I just wanted to say to everyone that, you know, I think we all really recognize how difficult it is with Zoom all the time, and even if you're, you know, if you're very used to it, just looking at the screen is a pain. But sometimes, particularly when we have the guest speakers, but also for Tim, I think even if you're looking at the screen, if you can keep your screen on most of the time, it just gives us a sense of who's in the room and getting a sense of engagement. So if you're busy eating your lunch, I understand that might not be terribly attractive, but do try and put your screens on when you can, because it really helps us.
Yeah, thanks, Kathy. So hopefully you can see this. It says 3 because we sometimes have Alan go second here, but I've kept it. We decided to give him more time in bed this time round because he was getting up at 6 o'clock in the morning. So we're going to go on to the sort of where the money comes from and how you measure returns, and then we're going to go back after the break with Alan will be joining us at that point, and we'll introduce him, and he'll talk about what it's really like in Silicon Valley. So the plan of this session is to think a bit about where the money comes from and what way you might intermediate capital to early stage ventures. We're going to mainly focus on venture capital funds because they are the dominant source of structure by which these are done. And I should say at this stage, some of this might be, in terms of the structure of it, might overlap a bit with private equity, which I think you've already done, right? Or some of you have done. Now, I don't have a good sense for how many of you have done it. So would somebody who was in both rooms give me a very rough estimate of what proportion of the people in this course have already taken the private equity course? Can one of you do that? Because if it's like 50%, it's different from if it's 90%. So is there anything coming up on chat, Kathy, giving us that estimate? No?
No, nothing's coming up yet, Tim, but I thought Dan was about to say something. No, he wasn't about to say something.
I can give you the numbers if you want.
Yeah, roughly, Bryony, what's the overlap?
So there are 8 people who are doing this course that haven't done private equity, but everyone.
Oh, okay. Only 8.
Mm-hmm.
Okay, that's fine. Well, that's very useful to know. So I won't spend a huge amount of time on the fund structure, but I will cover it a little bit because there are some distinctions there which are different from private equity funds. But in this, I guess you've also then, a lot of the people have already looked at how returns are measured, and what I'll tend to focus then on more is the returns, which will be perhaps the most interesting bit anyway. So anyway, in the VC world, let's look to begin with at how you might invest in early stage businesses. And
Tim, if I can ask a question, if you don't mind.
Sure.
So if we can cover how venture capital goes into private equity as well.
So you mean how private equity starts getting involved in businesses which are initially funded by venture capital? Because in some ways venture capital funds don't become private equity funds. They keep doing what they're doing. But is that what you meant by in your question as to?
No, so what I meant is vice versa. So how venture capital firms progress to private equity funds. Because that's what I've experienced and that's what I've seen. But
yeah, do you want to give me just a bit more? Just give me an example or something which would just illustrate that for me, because I do see that over the years, some companies that started off as venture capital funds, you know, if you think of something like Schroeder Ventures became Permira, which Schroeder Ventures was a venture capital fund, and it decided to basically stop doing that and become a private equity fund. So that's one interpretation of your question, but I'm not quite sure that's exactly what you mean.
That's exactly what I mean.
Oh, okay. Then, yeah. So maybe I can deal with that up front, because it's sort of, I think that there is a general tendency here over the years, which is that in what I've showed you to begin with was this huge growth in venture capital through to the sort of early, until about 2000. And then it fell away. And actually when it fell away, a lot of what happened then was a lot of what grew into its place was private equity. In other words, sort of buyouts, growth capital, investing in more mature companies. And so a lot of the companies that were doing venture capital decided to sort of pivot themselves to go higher up into a later stage investing. And they did that because the returns were still very good on buyout investing and sort of more control-based investing. Because with venture capital, you don't control the company. You own a stake in the company. You might own a 5-10% stake in the company, but you don't control it. And that's a big difference. Whereas the buyout guys essentially control the company. And I think they moved in there because the returns, there were some very bad experiences with the venture capital in the early 2000s, as we'll see. And there were lots of opportunities to go into growth capital and buyouts, and sort of, there was a big, what was sometimes called a de-conglomeratization wave, where lots of these companies, public companies, had grown up to own hundreds of divisions of lots of different businesses, and they basically started shedding them off. And so there was that big growth, and lots of the names in venture capital became basically buyout companies. And in fact, if you think of, some of the biggest buyout companies in the world now, like CVC, what does CVC stand for? Anybody tell me? CVC is the largest European private equity firm. They're like the Blackstone of Europe. So anybody know what CVC stood for? It was Citibank Venture Capital. They were Citibank's in-house venture capital arm. And then they certainly don't do venture capital now. Their latest fund is like 20 billion euros. So I think people go that way because you can make a lot more. It's a bit of a safer model. They're larger funds. You can get good management fees on them. All the things that Ludo told you about in terms of, outrageous management fees and the like, I think are more there on the buyout side than they are on the venture capital side. But very often a venture capital fund might only be $100 million, $50 million, and a 2% management fee on $50 million isn't that much. It's $1 million a year. So it's not like they're going to get rich on the management fees. So there is a reason why people morphed into it, because you do get rich on $1 billion fund, irrespective of whether you make any money, because 2% of $1 billion fund is, for 10 years, is a lot of money. It's $200 million over those 10 years. So I think the reason why they did it was for economic reasons, and also because the returns on VC had been pretty bad, as we'll see, for a while. Does that answer?
Brendan's just got a question about VCs and loading agreements with more warrants than private equity.
So the question is private equities, because they are more actively involved in the organizations. Don't VCs tend to more look for the agreements to secure the interest particularly via warrants? So, and I mean by, especially around the statements that the founders would say, if depending on what they think the EBIT is, what they term the market size is, all that kind of stuff, they normally lock down in warrants. Is my understanding the same as yours, or am I misled?
Well, I think so. These are sometimes called representations and warranties, right? Reps and warrants. So these are things where you get the founders to say that the information that they've given to the investors is the sort of truth, the whole truth, and nothing but the truth. And to some extent, I think my interpretation of them, and this is a good question to ask Alan, is that there certainly are a lot of personal representations and warranties that are given by an entrepreneur, but I think they're more there, in truth, that you make them, you sort of make them take it seriously, insofar as they sound very draconian. They say you've got to warrant that every piece of information is true, and da-da-da-da-da. And that makes people think, if you're an entrepreneur, this is pretty scary, and you've got to be truthful and not tell them about the or you've got to tell them about the outstanding lawsuit that you haven't told them about, because that would be, in violation of your representational warranty. But in truth, the number of times that investors go after entrepreneurs for violation of reps and warranties could be measured on the fingers of one hand, because there's not much to, in the case of a bad outcome, there's not much to go after. So there's a lot of, it's almost like one of those things where entrepreneurs worry about it a lot, and are sort of right to worry about it in a way, but the number of times that you actually see them being used against the entrepreneur is actually very small, I would say. And that most of the time, the investor is more concerned to get control via voting and board seats. And we'll come on to that a bit as to how they get control, but essentially they use their role as a board, their board representation and their equity stakes, and some of the other legal terms in the term sheet give them a lot more power than reps and warranties, I think. So I sort of agree with you and don't agree with you, if you see what I mean. I think they're definitely there. There's a lot of focus put on them, but they're not that important in practice.
No, and in fairness, yes, they normally do put somebody on the board. It's just trying to understand, because there's normally, I've seen PE agreements with the warrants being quite thin versus a VC agreements where the warrants are much larger. So
yeah,
that's what I was asking the question.
And I think that's fair, because in many of these cases, you know, with the more established companies that private equity firms are going into, they're much more established. There's much more data, and they've got 10 years or 5 years of published accounts and things like that. So it's not necessarily the case that so much is unknown. All you really want to know is that you haven't violated somebody's IP, or, you know, you're not just about to leave, you haven't done anything bad, there's no pending lawsuits, things like that. So I think it's true that private equity deals have less on that. Okay, so let's just think from first principles about how you put money into an early stage venture. And, you know, the way it works in many countries is that the very first type of vehicle which is done to do this is actually like a corporate vehicle. So you can create almost like a holding company that can invest in the shares of early stage businesses. And so you can create, for example, a listed company whose job is to do investments in early stage businesses. And one of the, in many countries, the first examples we see of businesses investing in early stage ventures are like this, like business development corporations, BDCs in the US, in Europe, venture capital trusts or investment trusts. So, you know, one of the leading examples of that was 3i, which was founded, you know, in the 1950s, which was called Investors in Industry, which was set up, and the banks were told to seed a fund which would invest in early stage businesses, because every government, you know, almost all governments believe there is a shortage of capital to go into early stage businesses. This is sometimes called the equity gap. Now, personally, I'm not at all convinced that the equity gap exists, but, you know, the governments worry about it, and generally speaking, it's one of those areas of finance that governments want to have more equity available for early stage businesses, and so they very often will create incentives to businesses to do this. And so you can set them up as corporate structures, and they have these certain advantages insofar as they're what's called evergreen structures. They're, you know, you invest in a startup business, some of them will go bust, some of them will generate a return, and then you keep the return and you put into a new company. And so, you know, you invest in a large portfolio. This is what 3i did. They might have had 200 portfolio companies. In fact, the company I was involved with, Verivox, was funded by 3i. In Germany, it became Europe's biggest venture capital fund. And, you know, they've always got money available in a way, but they do, the return to the investors in 3i come through dividends in a normal way and through share price appreciation. So you can go onto the website or you know, go on Bloomberg screen and see what 3i is worth, but it's actually a corporate investing in early stage businesses, or it was. It's actually morphed more into later stage these days. But they, you know, so they act like a corporate, they pay dividends, they'll typically have to pay capital gains tax at the corporate level. So if you make a gain at the corporate level, you pay corporate taxes. And that's one of the problems, because any outside investor who, especially the outside investors, the big outside investors in the world, like pension funds and sovereign wealth funds, are tax exempt. And they don't want to invest through a vehicle which is less tax advantaged than they are. And that's why partnership law came about in many countries. And partnership law, limited partnerships, essentially are tax transparent vehicles whereby there's not tax captured at the level of the partnership, it's taxed in the hands of the individual or the entity that's putting the money in. And in many countries, you actually see the growth of the venture capital industry being coincident with when partnership law or tax law was set up so that these things were allowed to exist. And these are I don't want to spend a huge amount of time on taxation, but it's quite an interesting topic because, you know, in some ways you're constantly seeing these challenges to partnership law because they're thought to be almost like too tax beneficial, because you can have, certainly for some tax exempt investors, there will be no tax captured in anywhere through the chain of this. So generally speaking, these corporate structures which don't have that feature don't tend to attract investment from the big pools of capital like pension funds and sovereign wealth funds that are tax exempt. The other thing about them is that typically the people who work for these organizations are paid a salary and a bonus. They're not paid so-called carried interest, a profit share based upon the profits of the entities they're investing into. And so typically, and this might be a bit unfair, but I think organizations like 3i have been fantastic at a fantastic sort of training ground for people who want to do venture capital. But as soon as they're any good, they will go off and set up their own fund and do it under limited partnership structure, where they can actually get a bigger amount of money, not least because for a public company, of course, the remuneration is public, whereas for a partnership, it's not. So the sorts of pay that you see, you know, being earned in these funds is not actually widely known how much they're earning. So it's there are pros and cons, but these things exist in many countries, but they're not normally the dominant form of investor. Even though they're simple and they're sort of straightforward and they don't have huge costs, but they don't tend to be the dominant form. A second type is, and this has grown a bit more in recent years, a corporate venture capital firm. So rather than have something which is entirely divorced from a corporate entity, they're just investing in startup businesses. You get some where essentially the money comes from a corporate entity. So, you know, GV, what used to be called Google Ventures, typically gets $50 to $100 million of Google's profits that it makes from AdWords and invests it in early stage ventures. And those have become quite big players in this field. Now, the way they're organized actually differs a great deal. Some of them pretty much operate like venture capital funds, I would say. And most of them are financial in nature, insofar as they're trying to make money and they're not necessarily trying to get the next sort of acquire necessarily the companies that they invest in. That is the fear from a lot of entrepreneurs, is that, you know, you'll get invested in by Intel Ventures, and if you're promising, they'll somehow try to absorb you within Intel. But I think that's quite a rare thing. Most of these are actually more done because people, in a sense, the corporate wants to have a first look at some of the sort of the promising new ventures, and some big companies find it very hard to generate an entrepreneurial culture within their own business. And so I think these have become, you know, most big companies now have one of these, but most of the time they behave more like venture capital funds than anything else, actually. They're not normally trying to acquire the companies or have some preferential, you know, route to acquisition. But they're interesting, and they've certainly been growing. But the main form that you see are limited partnership funds, which, for those of you who've done the private equity course, you know all about these. Most of the structures here are pretty similar, except for a lot of the things that Ludo gets extremely excited about are not here in venture capital, right? So let me make a prediction. Ludo spoke a lot about portfolio company fees. Am I right? there's a few hands in front. You know, they put fees on everything. They charge a fee for getting out of bed in the morning. They charge a fee for getting a cup of coffee, all this sort of stuff. That doesn't exist in the venture capital world. What happens here is they are the same structures. They're 10-year life structures, typically. You use the money once and then give it back to the investors. They're for sophisticated investors only. And so, you know, they're not for retail people like you and me. They give a discipline to exit the investment. So you don't get really paid your profit shares until you exit. And so that's really important, because a lot of entrepreneurs seem to be surprised when, you know, the VC firm wants to talk about exit, but that's just because, you know, you should know that that's what they want to do. That's the way they get remunerated. So don't take their money if you don't want them to exit at some point in time. Having said that, the exits are taking longer and longer, as we saw on the chart in the previous session. But you know, they have to exit. They typically pay no taxes at the fund level, which is good for investors. The management fees tend to be 2.5%, sometimes 3% of the invested capital, but the funds are smaller. So a very large VC fund would be $1 billion, whereas a very large private equity fund would be $20 billion. So they are much smaller, which, you know, can be one of the reasons why the fees are low. And they are structured to allow a carried interest to accrue. So in other words, the people running the fund, the general partners of the fund, typically or almost always get 20% of the profits. Sometimes in VC, they get 30% of the profits. So it's a bit richer than in the private equity world. But like private equity funds, they have absolutely no requirement to reveal the pay or profit share of the venture capitalists themselves. So, you know, you won't know how rich some of the people are who will be speaking later in this week. I don't know how rich they are, but you know, that is not in the public domain, unlike if you work for 3i. On the other hand, what you have to do is you have to keep raising money, and you're only as good as your last fund. So, you know, if you have a real dog of a fund and lose, you know, 50 cents on the dollar, you're going to find it quite hard to raise your next fund. And you know, the carried interest, your profit share, only really crystallizes when the funds are returned to the investors. So you don't get it as you go along. You actually have to wait till the end. Now I actually should get the chat window up here.
Yeah, so Simon had a question saying he'd never seen 30%.
Oh, well, welcome to this world. This is the Silicon Valley world. So there are some funds that have 30% carried interest, which is interesting. I don't think it's probably slightly too rude a question to ask Brooke Byers, but I have this strong suspicion that Kleiner Perkins might be one of them. These are not generally in the public domain, so you just have to pick it up through surveys and things like that. But yeah, there are some with 30%. So that's limited partnership funds. In terms of the reasons why they exist, they basically exist for tax reasons and government policy, which allows partnership structures, I think. And if you think of the way it works, is that the timeline is, you know, and some students actually want to go on after their EMBA and raise a fund. So this is sort of realistic timeline that can take you like a year, sometimes 2 years to raise a fund. If you've got a great reputation already, it might only take you a month. But fundraising takes a while. Then you have 10-year funds, which are split into 2 periods. There's a sort of drawdown or investment period, which is the period over which you're allowed to call the capital from the investors. So when the investors commit, you know, $10 million to your fund, they don't send you a check for $10 million. They wait until they find a profitable opportunity, and then they ask you for the money at that stage. So they can do that. The partnership agreement will say how long they've got to do that, but it's typically 4, 5, 6 years that they can do that. And then after that, the next remainder of the fund life is really designed for realization of those returns, or some follow-on investments to the existing companies. Like, you're not normally allowed to go out and find a new company to invest in. But if there's a follow-on round, the funds will typically keep 30–40% of the capital for follow-on rounds of companies that they invested in during the investment period. Okay, but the main thing you're trying to do is to start to realize some of the investments so that you can then go back, you can start paying yourself carried interest. So the cash flows start going back to the investors in that period, and then very often there's a fund extension. So you very often have not got completely through the whole process of investing and exiting within 10 years. So you often will ask for 1, 2, 3, sometimes 10 years of extensions. You do get some venture capital funds that are still running 20 years after they started. And about halfway through, you start marketing your follow-on fund. So because you've always got to have money to invest. So you've got to, once you've invested, say 60–70% of the old fund, you're normally allowed to start raising your next fund. Okay. Are there any questions about that structure? I guess many of you will be familiar with it, but anyone who isn't in particular, I'd be very happy to answer any questions on that.
Hi, Tim.
Yeah.
So this is Augustine. I just want to ask, does the venture capital seeking for an extension affect the reputation of the venture of the VCs?
I would say it depends what the reason is. If you're sitting on, shares in Facebook which haven't exited yet, and you've got some really good investments in there that just haven't gone public yet, no problem at all. If you're sitting on a bunch of, what you might call zombie investments, the living dead, who, you really should try to get rid of, but it's year 15 and you've still got this stake in this private company that is sort of hobbling along but not really going anywhere, that would start to become a reputational hit, I think. So I think it depends. In general, if you've been successful, no problem. If you haven't been so successful, really it is a problem, I would say. Laurent, you got your hand raised.
Yeah, I was wondering if you could share some details on what is the skin in the game for the general partner in those funds.
Yeah, let's do that. In fact, that is my next slide. So let me just go there, because this might explain what's going on there. So you can, the way you can think about this is you've got this partnership at the bottom here, which is made up of, if we start down the right-hand side, what I'm going to call here other investors. They're the main investors in the fund. So those would be your pension funds, your sovereign wealth funds and the like, who put money into the fund and put most of that money in. You then have the general partner over at the left-hand side, which is getting a management fee for running the fund. And if you were working for a venture capital fund, you would be an employee of this entity, the manager over the left-hand side. So, if you're an associate with Jenkinson Ventures, I've probably got some company set up called Jenkinson Fund Advisors, who is an advisory fund to the limited partnership. So if that's called, Jenkinson Harvey Ventures 1, and there's Jenkinson Harvey Ventures 2, then it might be that Jenkinson Fund Advisors is advising both of those funds. And that's where the 2% management fee goes, up the left-hand edge of that. Now, the really interesting one is in some ways the middle section here, which is where does the carried interest go and how much do you put in for that carried interest? And they're what are called special limited partners, because they're actually investors in the fund, because you have to put some money in order to get skin in the game, and your share, and for tax reasons you have to have some money invested, otherwise it won't be treated as a capital gain. It'll be treated as a bonus or income. So the typical amount in an early stage fund would be something like 2, 3, 4% of the capital would come from the individuals who were going to get the carried interest. So for putting in, say, 2% of the capital, you'd get 20% of the profits, which is what's so sweet about this in some ways. But actually, with venture capital funds, they tend to invest a lot in their, when they've been successful, they often will get up to like 10, 20, even 30% of the capital will come from the special limited partners. So that they are, you know, actually co-investing alongside the institutional investors. So it gets to be quite high in venture capital funds, much higher than in private equity funds. But to begin with, when you haven't got enough money, because you know you've got to earn money to invest money, so most people don't have enough to put in more than a couple of $1 million of carried interest in $100 million fund. Does that answer your question?
Yeah,
now I see two other people have got their hands raised. Let me just see who they are. So
Fabian and yes. Well, Fabian and Laurent still. Yeah.
Thank you, Tim. So for the SLP, can be the case that the special limited partner be at the same time the general partner, or they need to be different?
Yeah, so they sort of wear two hats. So what essentially will happen is that we're all sort of employed by the general partner. So even Kathy and me as founders of, you know, Jenkins and Harvey Ventures, we will be paid a paltry $200,000 a year as a manager, you know, for working for the general partner. But we will ourselves be investors in the fund. Oh, sorry, we will have a share of the carried interest, which comes through us putting our own money into the fund. And as I say, we might put in 1 or 2% of that money. And so we are actually got both hats on. We take a share of the management fee through a salary for doing our job, and we get a profit share or a carried interest by being a special limited partner. And so if you were, for example, an associate at our fund and you didn't get a share and we hadn't given you a share of the carry, all you get is your salary and a bonus we give you, but you don't get the you don't get any carried interest as such. And typically the carried interest is kept quite tight. It's not like it's given to everybody. It might be only the people who are actually involved in a particular deal.
And then for the carried interest is only for the people that they invest part of it, invest on the fund. They
have to, because otherwise it won't get the tax treatment. So yeah, that's right. So you have to. To be honest, it gets a bit complicated, because you very often set up the entity that will get the carried interest as a separate entity in a tax-free institution or place like Cayman or Guernsey or Jersey. So you set up Jenkins and Harvey Carry Collector LLP in some place, and you can then allocate the carry, allocate people shares of that carry in a tax efficient way. So it gets very complicated.
Only going for the Cayman Islands, Tim.
Or Mauritius. Mauritius is another place.
Mauritius is okay. I'm not, but not Jersey. Not Jersey. Yeah.
Actually, most of them are in Jersey and Guernsey, but
that's the Isle of Man.
Yeah, but that's the way it sort of works. So it's really structured there to be tax efficient.
I agree with Kathy. Everything goes to the Cayman.
Yeah, well, actually for tax reasons, most US fund structures do have their fund structures in Cayman, but most ones with Europe, you very often set up. I mean, the sort of structuring of these funds is an industry in its own right. And if you have Asian investors, for example, they will very often want to have a parallel fund which is actually structured in Mauritius, because they have better tax treaties with Asian investors, and European investors like Guernsey, Jersey, or Luxembourg, or sometimes Ireland. So, you know, there are people who work for, you know, Deloitte, KPMG, EY, who spend their whole days just structuring tax, you know, structuring these things to pay as few taxes to the government as possible. So it's not sort of good work, but it's remunerative work, I would say. Okay, so in terms of the sort of, just to finish off the fund structure part, in venture capital, the annual fees tend to be around 2%, but they sort of vary between 1 and 3, and so they're very often a bit higher than in private equity. only get paid the full fees in the investment period, and after that they normally drop, either because they they might drop to, you know, from 3% to 1.5% or something, or the basis upon which they're charged stops being committed capital but then invested capital, or something like that. Carry is typically 20 but can be higher. Interestingly enough, in venture capital, you see the sort of typical 8% IRR hurdle there, but actually many venture capital funds have 0 hurdle, so in fact they don't have a hurdle rate at all, which is cool if you're a venture capitalist. And one of the reasons for that is that it takes quite a lot of these investments take quite a long time to mature. So IRRs take a long time to actually come about. And so some venture capitalists have managed to negotiate either lower IRRs, you quite often see 6, or for the big funds, you see typically 0 hurdle rate. And the other thing, as I've sort of mentioned, is that basically the thing that you really get is this % of the profit without putting up pro rata cash. So, you know, putting up, you know, you don't typically have to put up 20% of the capital to get 20% of the profit, which is one of the most attractive things about the whole system. Okay, so that's, if you like, the way that the fund structures work. What I wanted to do, and I'm going to do this because I realize you might have, I don't think you typically cover this in the private equity course, but in terms of looking at the way, so looking at some of the details about how you actually work out IRRs and carried interest and things like that. And so what I wanted to do in a second is to put you into groups to work through an example. But I wanted to say to begin with that there are still the main 2 metrics that people use to measure returns are similar to the private equity side in terms of internal rate of return and money multiple in terms of, or investment multiple. How much did you get back for how much you put in? So one is time dependent, the IRR, and one is not time dependent. It's just saying I put in $1, ultimately I got back $2, $3, $4 afterwards. Okay, and the IRR is relatively straightforward, but you'll see some complexities when we go into the little example, I think. The money multiple is a little bit more complicated because as you go through the life of the investment, you have, you know, to begin with, you'll invest some money, and then what you've got is a private company, which is, if you like, what's called, it's got an asset value, but it's not turned back into cash yet because it's still a portfolio company. And very often you have to measure these sort of multiples, or if you're trying to express what the returns are, you can't wait till the end. People want to know before 16 years or 17 years what the returns are like. And so you very often use the multiple as a way of doing that. And to begin with, it might be what's called the residual value, which is the sort of the amount that is still invested in the portfolio companies to the amount that's invested. So sometimes called the residual value to paid in ratio. Before it's matured, that will be, until you've got any money out of it, you're looking at the residual value of it compared to the amount of money you put in. Over time, you'll distribute the money back to the investors, and then it becomes a cash thing. So that's called a distributed to paid in multiple. In other words, how much cash you put in relative to how much cash you got out. That's very simple. And then when you pull these 2 things together, you might have got some money out, but you've still got some money in. It's what's called a TVPI, a total value to paid in. Now, in the example, that may mean very little to you, but in the example, you'll see I've got a little spreadsheet here for you to work through, which is asking you to sort of compute the returns on these funds for taking account of the fact that not all the investments will actually have been realized, okay, which is a complexity. And maybe what I'll do is I'll just stop sharing this screen and just show you what the spreadsheet does for a second. So let me just share my screen on another version of this. Just show one more window. Right. So what we've got here, and these are, this is real data. This is not, so what I've got here are 5 venture capital funds that were set up. This is actually data I got from the European Investment Bank, which is the largest investor in European venture capital funds. So what we've got here are 5 funds, one from Portugal from 2001, Luxembourg 2003, etc., all the way down. They have slightly different stages that they're investing in. But what I want you to do is, for each of these funds, I've given you the actual cash flows for these funds. Okay, so here are there's the money paid in, there's valuations at each point in time, and there's distributions that occur at times as well. So what I want you to do is, for these funds, I want you to be like a fund accountant and work out what the returns are. So I want you to work out the IRR, the total value to paid in, which will be the sum of the amount that's been distributed, the DPI and the RVPI, as it says in this one, the residual value to paid in. And I want you to just do this because, in my experience, a lot of people go through life never actually having worked out how you work out returns in these funds. And sometimes even having done Ludo's course, you don't necessarily know how to do it, or in the details of it. So what I'd like to do is to put you into study groups for maybe 20 minutes and see if you can work out, fill in these boxes for each of these funds. So the Portugal fund, then we've got the similar cash flows and like the Luxembourg fund, and then we've got all 5 of them. And if you I've given you a hint here that you've got to fill in this column here, cash flows for the IRR, because you know that you've got to have cash flows to work out an IRR. And so I'll put you into groups and then see how you get on. Are there any questions before I do put you in? Because this is available on the Canvas site, or indeed from the link on the URL, but probably better to get it from the Canvas site. But Kathy, were there some questions?
Well, there's one, I'm not sure relating to how to fill this in actually, but Laurent just wanted to come in with a question about performance.
Sure.
I was just wondering whether performance really matters in the early years apart from impairments. And
it doesn't. I would say not very much, because it's, you know, nobody really works out performance until about 4 or 5 years into a fund, for the reasons that you say, that, you know, it's just, they're normally like, you either know that it's, you don't necessarily know whether it's succeeding. What you probably know is if it's failed. In other words, if it needs to be impaired. And so that's interesting. But no, I tend to agree. In fact, what I've done here is I've given you the cash flows. What I want is the performance at the end, right? So I'm not interested in the performance as you go along, but here I want the performance 10 years afterwards, right? So that's what I want in these boxes here, is how would you assess the performance of the fund at the last date that I've given you? Okay. So maybe I'll put you into study groups now. How many people we got here at the moment? I should look at that on
31. We're on 31, Tim.
Okay, I'm going to put you into groups of 6 so that you've got 5 in a group and you can help each other. But what I'll do is I'm going to give you 20 minutes to have a look at this, and then we'll come back and see how you got on. And I'll just give you then I'll finish off by giving you some sort of macro information on the returns. But have a go at this and see if you can work out, fill in as much as you can, and then I'll show you the results afterwards. And I'll also make the spreadsheet with answers available at the end. If you're really interested in the sort of definitions and the like, there is a set of instructions here, but I don't suggest you really look at them. They just tell you, if you like, you know, what I've just said, but it gives you all those instructions if you want it. But basically start with fund 1 and see how far you can get through. Once you've got the basic idea, it's all the same. So there's just a few differences between the funds that you'll have to think about. Okay, so that's let's do that. I will put you on the clock for 20 minutes, unless there's any questions before we go. Okay, so I'm going to put you into 6 breakout rooms, and I will, yeah, and we'll come back in at 22 the hour. Okay. I'm going to open all the rooms now. Doesn't seem like a big enough difference. Agreed? So what's the reason? And this, I'm sure Ludo has probably told you all about this. So who wants to give me Ludo's answer, or indeed your answer via Ludo, as to what's going on here?
Yeah, Laurent's got his hand up.
Okay, Laurent, you can do it in a French accent.
And Steve,
as well.
and Steve, although Steve may have his hand up because he couldn't be bothered to push it down.
Steve, you want to go ahead, please?
Steve, did you want to answer this one?
Isn't it to do with just the I mean, it can't possibly be correct when you look at the cumulative paid in compared to the cumulative distribution. If the implication of IRR would be that that's the discount factor that gives you 0 net present value, but if you just look at the raw numbers, it just can't possibly be correct, because it kind of sounds like it's compounding at 165%, but you can see from the difference between 10 million and 25 that it's not. So it must be that the funds were just uninvested until later, and then the rate appeared very high at the end, isn't it? Something like that?
It's something like that, but not that.
Okay.
But you're on the right sort of track. Laurent, what's your interpretation?
It's just a mere effect of time value of money. I mean, if you manage to realize investments at a huge return in the early years, in the early time periods, you've got an IRR that's going to stick with you for the rest of
time.
Yeah,
which is sort of the same point that Steve's making, but a little bit differently, right? So, and look at this Italian fund. Look how quickly they got their money out. Like they get those distributions out within a year of putting the money in. So, you know, you've got a huge increase that bakes in an IRR to such a huge extent, so that you've had, and you know, look at the date, it was before the dot-com bubble burst, right? So you've got a huge effect there. And at this stage, I like to do something which normally leads to everything breaking. But if I were to take this 3.173 million here and move it a bit later in the fund, like, let's just see what happens. So it's going to be the same cash flow, but just later. So I'm going to zero this out, okay? And now I'm going to, so all my figures are going to look wrong. And I'm going to put it down here, okay? So what was it? 3.173, well, I'll just call it 000. Okay, so what's the result going to be on IRR? It was 165 before. Any bids? What do you think is going to happen? There's no change in the cash flows. It's just the timing of the cash flows. Okay.
How many years later? That's.
I've pushed it about 5 years later. So well, let me show you. So the IRR here has gone down from 165 to 111 just by moving one cash flow. 5 years. It's the same cash, it's just later. And that's the problem with IRR, is it's very dependent upon the timing of the cash flows, right? So this is one of the things here. That's the reason why the German fund looked similar to the Italian fund, is simply because the Italian fund got its money out sooner, and IRR sort of assumes that you reinvest the money at the same rate and get the same return, which you know, will you do that? If you've got that sort of rate of return, it's very you know, it's not compounding your money fully invested at 165 pounds for 10 years. Otherwise, sorry, 165%. Otherwise, you would have made God knows what, you know, like 30, 40 times your money. It's not doing that. It's just saying for the time you had the money, you got 165%, but you didn't have it for very long. You only had it for a year. That's one of the problems with IRRs, and that's why they're a bit deceptive. Very susceptible to quick, early returns of capital. Okay, does that make sense? I mean, I hope that's useful, because I think it's a really important message, and it also shows that, you know, these performance measures do depend upon your assumption about you know, what's going to happen to that terminal value. So here, it's not a huge amount that's left in the terminal value of this fund, not much at all, 870,000, but you're assuming it is a cash flow at the end, conventionally as well. Laurent, you had another question?
Yeah. Does that mean that we, as an investor, we should negotiate a lower carried interest for the early exits? Because obviously they are easier to get, and any seasoned venture capitalist will certainly know the trick. So they will certainly exit early on the INSI investments.
The thing is, if you did that, they wouldn't exit them, right? Because they want to get the carried in. The carried interest to them is a function of the money multiple. So the money multiple is the TVPI. So they get 20% of the profit, so which is the TVPI minus 1. So in this case, you know, they're going to get 20% of the profit, which is 2.5 minus 1. So they will, if you say you're only going to get 10% on early cash flows, they'll just say, oh, I'll wait, I won't give it to you then. So it doesn't, you don't see it in practice, and I can see why, because you could just game it if you did that. But certainly early cash flows make IRRs pretty meaningless, which is why you can end up with investors saying, you know, these hurdle rates of 8%, why, you know, they might sound high in a zero interest rate environment, but they're not that high, given that you can screw around with IRRs pretty easily by taking the money later using subscription credit lines, which probably Ludo talked about, and you can also give it back early in some cases as well, and they bake in an IRR that will never go down really.
Tim, this is Sheldon. In our group, we kind of used IRR instead of XIRR, and we basically just summed up the net cash flows in a year.
Yeah.
So the numbers actually didn't change a lot, but they do look different.
Yeah,
and,
they will.
So
yeah.
Is there a standard, you know, IRR methodology that's used when funds report, or do you go by exact transaction date?
You would go by exact transaction date, because it actually makes quite a big difference to the numbers in some cases. If you had to take a stupid example, if you had a distribution on the 30th of December and one on the 2nd of January, you know, and they fell into different years, and you did it on an annual basis, then one would be quite different from the other. And so people use XIRR, and they use exact dates, exact timed cash flows, because it's easy as well, right? There's nothing more difficult about using XIRR than using IRR, and one is more accurate. So yeah, that's the way it's done in practice. But again, the thing that you're saying is very common. I've found over the years that people think of this is in annual data, whereas this isn't annual data. This is actually timed data. So this is the way you would do it. The way I'm doing it in this example is the way that the fund would do it. Okay. Okay. So I'll post the answers to this, and I think that the point is, in some ways, is that it's important to know what you are measuring, and that at the end of the day, what you really care about, I think, is how much money you get back from the money you put in. So I would personally say that the money multiples are the more interesting of the variables, but that IRRs are not uninteresting, because they do show how long you kept the money in order to generate 2-3 times the money. So they're both interesting, and most people actually look at both of them when they're looking at performance. And maybe what I'll do now is just take, what should I do? We're just running a little bit behind time, but that's not a major problem. Shall I just show you some, if you're not feeling too tired, I'll just take 5 minutes to show you what the returns really look like across the industry. So let me just share my other screen with you. So this one. Okay, so now we're going into what I'd call research mode, in terms of now we're moving from examples into some of the academic research I've actually produced in this area. And there's this paper which is sort of quite well known in the field. It's actually one of the most downloaded papers in the venture capital private equity area, called "What Do We Know About Private Equity Performance?" And this includes both buyouts and venture capital. And I've updated it here up to the end of this year, which is sort of the latest figures that we've got, to show you what across the industry, this is global, across global venture capital funds. It's a sample source from probably the best data source that you can get on this, which I have access to. And this shows you what vintage year IRRs look like for the median fund. Now, there'll be a lot of variation around this, but this is what the median looks like. And so before the dot-com bubble burst, the median fund was returning 30% IRRs. And some of the top quartile funds were in the hundreds. Then there was this massive drop, and essentially for quite a few years, the typical fund produced an IRR close to zero. From 99 through to 2004, you can see here. It's not much different from zero, which is, you know, you put in $1, you get back $1 10 years or 15 years later. But if you look here, the returns have been going steadily up over time. Which is very different, as we will see, to what happened on the buyout side or the private equity side. So the IRRs now in the more recent vintages, and I've stopped at 15 because for the reasons that have been discussed earlier, it starts to become a bit meaningless to look at a fund which is only like 2 or 3 years old. I've stopped here at funds which are like 4 years old. So these may not be ultimately what they turn out, you know, the returns, but they're now, you know, in the mid-teens percentages, I would say the median fund, which means that the top quartile funds might be turning 30, 40, 50% IRRs. So that's across the globally, if you like. If you look at the TVPIs, the multiples here, they were at like 3 for the median fund. They then dropped to below 1 as lots of funds lost money. Over the life of the fund, these are vintage year returns. So it's the 1999 vintage year funds. Eventually, the median fund gave you 70 cents back for every dollar you put in, roughly, which is a terrible return. And it took a long time for you to get the 70 cents back as well. So these had lousy IRRs and lousy money multiples. Since then, they've been, more recent vintages have been about a 2. These are net of fees and fees and carried interest payments. These are the returns to the investors. Okay, so if you're doubling your money on a fund, actually in the last, you know, recently that's been a pretty good outcome. And again, these are medians, they're not the high performer funds. In terms of if you might think, well, what about the spread and are they in the carry? This is the IRR of the funds from top to bottom quartile. Okay, so you can see here that, you know, in those mid 2000s funds, you know, even the top quartile funds were barely getting into, like, the top quartile in 2004 was like 6%. So if they did have hurdles, relatively few of them were hitting 8% hurdles. But over time, you see they've been going up pretty steadily. And now, for example, if you look in 2013, even if there was an 8% hurdle, like the bottom quartile fund would be in the carry. Because if you look there, the 2013 fund, the bottom quartile, which is the lower part of the bar, is at about 11%. So you're giving carried interest payments to 75% of the funds. And remember that they don't all have a hurdle at all. So generally been a steady growth in returns, which is why people you know, are getting much, much more interested in venture capital. And if you compare this to buyout, so this is sort of slightly treading on Ludo's toes, but buyout returns have been coming down. They're in the red line. This is money multiples or TVPIs. They've been coming down, whereas VC multiples have been going up. And so they've actually been converging in many respects. And in recent years, the returns for venture have actually been higher by vintage year than the returns for buyouts, which was absolutely not the case. When I started teaching this stuff in 2000 and I was doing, you know, buyouts, all the buyout guys thought the venture guys were complete losers. They'd say, oh, why are you doing venture? Like, everyone loses money in venture. Well, the boot's on the other foot now. and the VC guys are the cool place to be because the returns have been better. A slightly different lens to look through is if you look on an annual basis. Some of you may have seen charts like this, which basically show the best performing asset by each year. And this, just to be clear, this is annual returns. So it's like taking all the funds and working out the return over the previous year, irrespective of what the vintage year is. So these are not vintage year returns, they're annual returns. But look at the number of years recently that the top performing asset has been venture capital. And, you know, okay, buyout is there or thereabouts. The dark blue is normally in the top half. But venture has been the top performing asset in 1, 2, 3, 4, 5, 6, 7 out of the last 10 years, which is why there's been a lot more interest in venture capital recently. And you'll see there, natural resources there sort of firmly sort of wedded to the bottom, except for 2016 when it was top and venture was bottom. So, you know, there's a certain amount of movement around, but there's some trends there which are quite interesting, I think. Now, you've been told, especially those of you who have taken the private equity course, that what matters is you should compare it to other assets, and maybe you should compare it to other equity assets. So one way of doing that is to basically do what are called public market equivalent returns. And I won't go into too much detail on this, but essentially it's like creating a mimicking portfolio where when you're investing in the private asset, you could also invest in a public asset, and you work out which is more where you end up with more money. And if you do that for venture capital, this is again at a global level comparing to the MSCI World Index. You see that actually for most of this period you were better off in the MSCI World after fees and carried interest payments, but that's not true after 2009. You know, so the early years, like before the dot-com bubble, it was great to be in venture, and actually in the last 10 years or last 6 or 7 vintages, it's been actually better to be in venture than in the MSCI World. So things have changed a bit, and it's actually been quite an interesting, you know, this is one of the reasons why venture capital has expanded, is because it's been done pretty well. And you might say why, and I've got my reasons for that. Maybe we'll talk about them another time, but there are certain theories about this, but it's certainly been an asset class that has performed very well.
There's a bit of a conversation going on in the chat with Brendan, Steve, and Borai around distressed assets making more money, and buyouts doing much better than VC when the economy is in crisis. And so I don't know if anyone else wants to join this argument, or whether you have a view, Tim. The great Jenkinson finance predictor, for which I would always put serious levels of risk against.
I have no good crystal ball, but my interpretation of this is we are going through a period of unexpectedly or maybe exceptionally large opportunities for new ventures in lots of different fields, from artificial intelligence to autonomous vehicles to biotechnology to all sorts of things. And I think that this is what's showing up here. You know, we've had social networking, we've had, you know, all sorts of, we've had, you know, the sort of digitalization of the economy. We had all sorts of areas where there's been huge returns to be made. And I think this is has been an exceptional period of potential for innovation, actually.
It'd be interesting to ask our guests that, because back in March, we had some interesting comments from Reed about that, and also Cal. And I think 4 months on, you know, it'll be interesting to see if their views have changed. And Brooke Byers, given his experience in the industry, you know, will certainly have some views about the whole biotech opportunities, I would have thought. Yeah,
I know, indeed. And I think that, you know, I think it's some of the patterns here make a lot of sense when you think about them, you know, in terms of sometimes distressed assets do very well, but actually there's sort of a bit the dog that hasn't barked. You know, I think that lots of people thought they were going to do super well after the financial crisis, and they didn't really. And so, you know, distressed have not been been the real killer app, as it were. buyouts have been pretty consistent, I would say, but venture has been the standout performer. And I think that's down to the time we're living through, which has had a lot of scientific and sort of changes in the way people operate and business models. And I think that's been really what's showing up in the numbers. Anyway, I'm aware I'm eating quite a lot of your time, so I'll just finish off the summary there, which I'll leave for you to digest. And then maybe what we'll do is take a break, come back on the half hour. At that stage, Alan will be joining us, Alan Morgan, and he will be with us from session 3 onwards through every day, and will indeed be leading some of Alan is an angel investor in California, and he'll explain a little bit about what he does. But Kathy and I have sort of built this course with him using his huge network of contacts in Silicon Valley. So he's a huge sort of contributor to this course, and would normally be there with us in the classroom. But you should treat him just like me, right? He's a co-teacher to the
with
course.
disdain, with disdain.
Exactly, with the huge respect but yeah. So Alan should be here when we come back after a break. So you've got 17 minutes to grab a cup of tea, but we'll leave the room open. So see you in a little bit.
So Tim,
has talked to several of our classes, a gentleman named Mark Randall, who was both a client of mine when I was a lawyer and a portfolio company when I was a partner at Mayfield. He and his colleagues, who formed a couple of companies, one was called Play Incorporated, one was called Serious Magic, moved to Silicon Valley from Kansas, where they had done a startup, and very quickly, raised money and were successful. I don't have them at my fingertips, but there are thousands of examples of that. So who are the players? For, again, 90% of the startups that matter, the world is quite small. There are probably fewer than 10 law firms who represent most of the startups, fewer than 100 angels who are shown the best deals and are quite active in the best deals. As you'll hear more, the line about where an angel investor is on one side of the line and a small venture capital firm is on the other side of the line is blurry at the edges. I think there are probably fewer than 50 venture capital firms, about half and half. I call firms that are less than $100 million micro venture capital firms, or micro VCs, and firms that are over $100 million traditional VCs. That dividing line is completely arbitrary, but you'll hear over the course of the rest of this week that the size of a venture capital firm has a number of different consequences for what kinds of companies it looks at and what stage of their development. We'll go into that more later. So that how the market, so to speak, is segmented makes a difference. There are fewer than 10 accounting firms, and as I put in the asterisk, most startups don't have an internal finance executive for some time, because the financial life of the company is not that complicated, and to pay an expensive CFO doesn't make any sense. There are fewer than 5 banks that have anything to do with startups, the most prominent of which is Silicon Valley Bank. So you can see, again, it is a small town. Next. The state of Silicon Valley today, this is my summary. Silicon Valley is enormously complicated. So if someone else did this, you might get a different picture. But the world economy is increasingly important and still troubled. And we put this slide together even before COVID-19 hit. Brexit is still hard to tell what's going to happen there, what, if any, effect that will have on the Silicon Valley ecosystem, which increasingly funds companies that try to sell globally. Anxious, are we in a bubble? This is a recurrent theme, sort of exacerbated by every time interest rates go to zero and the stock market inflates. You have a number of companies that go public at valuations that are hard to justify, including a number over the past 6 months even here in the US. These are a bit out of date, but valuations are growing. Uber, when it went public, had I think a $72 billion valuation, which has fluctuated since then. But Palantir, for example, it just announced it's going public, has an enormous, multi-billion-dollar valuation for a company that actually doesn't have that much revenue, or doesn't have enough revenue on traditional valuation models to justify the valuations.
Brendan was just
Sure.
asking a question about the COVID effect. Brendan, do you want to sort of elaborate?
Yeah, hi Ellen, thank you very much for your time today.
Sure.
The question I have is, I often talk to investors in the UK, and I can see the differences between their attitude to investing prior to COVID versus now. It's almost like, especially amongst the angel community, when I do due diligence and stuff for them, I see that their requirements have gone much higher and they are way more risk averse. And I was wondering if you are seeing the same thing in the community in the Silicon Valley and in the US at the moment.
I think the way I would summarize the experience here is in, I guess, late February, early March, when, as those of you who followed it, the US, is not uniform in its reaction to COVID-19, and some places have had strict lockdowns and other places have had very little by the way of restrictions. And it's become a hot political issue. But when the main states, including California, went into sort of strict restrictions on people's ability to get together in early March, the venture capital market, so to speak, just quit. And I would say over the last 3 months has started to come back. I think it is definitely still tougher for a startup to get financed, in part because most venture capital firms have, like we're doing now, are only meeting virtually or online. So that to the extent they're taking pitches, they're doing them online as opposed to in person, which is there are pluses and minuses, but there's certainly suboptimal parts of that. But because the partners in the firms aren't getting together on a weekly basis as they did in normal times, the process has slowed down. And there has been certainly an effect on individual venture capital partners, I think, when they saw their net worths get reduced by 30% in the course of a week, to just being cautious. My own sense, though, is that things are picking back up, and in my own practice, we've had 2 or 3 companies get financed in the past month. I would say, to your point, though, that the hurdle to jump over is definitely higher, because these companies were quite attractive to investors, and I think I'm working with one more company that I won't mention their name, but that is getting a lot of inbound interest from the top tier of VCs right now, but their business is exploding, so it's a good deal. But definitely a higher hurdle. But I think it went from totally quiescent to now working its way back to normal.
Alan, is there much evidence that I guess that the one argument here is the venture capital firms have to work a lot with their existing portfolio companies, so haven't got much bandwidth to sort of take on new companies. Is that the case, or do you think that is there not much that can be done through this period with the existing portfolio companies?
No, I think actually that's a great point, and one I should have mentioned in response to the question. The first response of a venture capitalist to an event like COVID-19 in late February, early March, by the way, here in the US, obviously the timing is different depending on where you are in the world. The first response is to stop looking at new companies and focus on your existing portfolio companies, because if you have an existing portfolio company that needs to raise money in the next month, 2 months, 3 months, you have the same problem with that portfolio company that a new startup does on its own account, is how do you get that company funded? So Tim, that's actually as good probably maybe even the main point about, in response to the question, is that what most venture capitalists did, including, by the way, my partner and I in our fund, was we just stopped looking at new deals and spent all of our time trying to make sure that our companies were adequately financed. So yes, that's a very important point.
Right.
Because you'll see later in the week that when you are, as a venture capitalist, when you are invested in a company, your interest in their next financing is very akin to the interest of an entrepreneur in their first financing. So if the market has shut down for new venture capital financings, it can actually affect venture capitalists themselves because they need to get their companies financed. Any other questions, or I'll move on?
None at the moment.
Okay, there are lots of exciting new areas, or some of these are not new. They've been around for in some, robotics has been a field for, I don't know, 40 or 50 years probably. But artificial intelligence or machine learning is quite exciting. There's a huge debate about the sort of everything from the ethics of that to will it replace people, but a lot of interesting applications developing there. Robotics is becoming very exciting, and not in the sense that you will have a robot walking around your house bringing you your cocktail, but in the way that most technology develops, the robotics is being sort of insinuated into a lot of the world. And so you will have robotic functionality in a number of different devices and applications. Healthcare, especially now, we created this slide pre-COVID, but even without COVID-19, healthcare has become, a very interesting area. Again, partly because of the ability to personalize healthcare sort of therapeutics based on your genome. The Internet of Things, again, is a revolution that is happening a little bit out of sight as more and more devices have sensors and are attached to the internet. Again, there are lots of debates about the ethics and surveillance and things like that about IoT, which are important. I drafted this as driverless cars. I should have probably entitled it autonomous vehicles, because it may be that driverless cars, which will, I think, eventually actually arrive later than a number of other autonomous vehicles, ranging from long distance trucks to autonomous buses in enclosed areas, commuter buses, and the thought of a driverless car that can actually navigate a highly complicated city center is probably the hardest task to solve. Driving a truck on an interstate highway in the US or a motorway, which is the same thing, in the UK or probably, in the EU or elsewhere in the world, is a lot easier from a computational intensity perspective. And the escape from Moore's law. Moore's law, most of you may know, is an observation that one of the early pioneers in semiconductors, Gordon Moore, noticed as he was doing a study of the increased density of transistors on semiconductors. And what he noticed was that it doubled about every 18 months. And transistor density on a semiconductor is the most important factor into how powerful the semiconductor or the microprocessor in the case of computing is. Moore's law has continued along a almost straight line since Gordon Moore first made the observation in the 80s. But because it's now so far down the path, there are sort of physical limits that are starting to impede its progress. One of which is that the distance between circuit lines on a semiconductor are now as small, or in some cases smaller, than the width of an electron. So it's hard to keep an electron on the path you want it to follow. So a lot of energy and research has gone into alternatives to semiconductor-based microprocessors, and you're starting to see some exciting developments in what's called quantum computing, which uses some of the I call them artifacts of quantum mechanics to build computers that, for certain specified kinds of computational tasks, can be enormously faster than microprocessor-based computers. So a lot of exciting things, and other people would have a list that includes some of these, but put other things on it. So this is not an exhaustive list. Tim, let's go next. As always, there are threats. California is the highest taxed state in the US. And this is an impediment to company formation, because many states in the US, Texas probably being the most aggressive in this case, actively recruit California startups to move to Texas because Texas has much lower taxes. California is a very heavily regulated state, that has become an impediment to doing startups. The amount of regulatory compliance required by even a 2 or 3 person startup in California now is quite high. Immigration policy is a mess in this country. Without sort of commenting on what is or isn't the correct immigration policy, the fact that it is a mess and is become such a political item, it makes it hard for startups to sort of hire immigrants. And the enormous impact that immigrants have had on the growth of Silicon Valley is hard to overstate. So when H-1B visas, as was just announced a couple of weeks ago, are going to be sort of highly restricted, that has an impact on companies in Silicon Valley, because many of the employees that work in the most promising startups are in the US on H-1B visas. So the fact that immigration policies become such a political hot potato is an impediment. The traffic, the crowding, the cost of living in the Bay Area, the San Francisco Bay Area and Silicon Valley is an impediment, and is causing people to think about, even pre-COVID-19, having a more distributed business infrastructure so that they don't have to have all of their people living here in the Bay Area. this URL is probably out of date by now, but this is an old article by Sergey Brin, who gave a speech 4 or 5 years ago saying that in his view, Silicon Valley had become fat, dumb, and happy. And if he were going to start his next company, Sergey Brin, for those who may not know, is one of the 2 founders of Google. He would start it somewhere else. And I put this under threats, although I think it is actually a good thing because it's not a zero-sum kind of system. But the proliferation of entrepreneurial clusters elsewhere in the US, but also globally, makes Silicon Valley, sort of relatively speaking, a smaller piece of the pie. Next. Now, the future, everything that we just went through in the prior slide has been used multiple times. In fact, in the entire 40 years that I've lived here, to predict the end of Silicon Valley. And so, somehow Silicon Valley keeps rolling on despite these threats. So next. So this quick, if there's no questions, then Kathy or Tim, I assume you'll stop me if people do have questions.
Actually, we do have
Okay.
something from Steve. Steve, do you want to sort of speak up rather than me just reading your question? I think that's always nicer.
Sure. I wondered if the high taxes in California explain part of the success, as well as potentially some of the indifference towards making a profit among tech companies. The reason I'm saying that is that I live in the Cayman Islands, where it's tax-free, corporation tax-free, income tax-free. And 10 years ago, they started a special economic zone to try and attract tech companies to start up in the Cayman Islands. And some of the discussions that I had with real tech companies, I would always ask them, why would you not do this in the Cayman Islands where it's tax-free? And their answer was really interesting, because they basically said, it doesn't really matter if it's tax-free if you're not making money. And in fact, one company pointed out that if they were to move to a tax-free environment, they'd have to write off millions of dollars of carry-forward losses. So it would actually work against them. So what struck me was that when you have a relatively high-tax environment, you accumulate these these higher carry-forward losses to offset against future tax. And by the time you're making money and you've used up all your carry-forward losses, you're then ensconced geographically and wherever you've been for the last 10 years, and moving is almost impossible.
Well, that's very interesting. I have never heard that before. And none of the companies I work with, which is not all the companies in Silicon Valley, of course, has ever mentioned that. The high taxes, so eventually my response to that is high taxes eventually will hit you, because eventually you have to become profitable or you go out of business. Even Uber, which is still burning, I've forgotten how many tens or hundreds of millions of dollars a quarter, it eventually is going to have to become profitable or it will go out of business. The high taxes, so will eventually hit the companies, but the high taxes are actually probably a more important factor on individuals. Because there's a very well-known phenomenon here in Silicon Valley, which is the minute your company is successful, has a liquidity event, not everyone, but many of the people who make the most money will leave California, and they will establish a residence in Texas. There's almost an industry. The state immediately to the east of California in the US is a state called Nevada. And Nevada has a very active effort to recruit wealthy Californians to relocate to Nevada. And because Nevada has no state income tax. So it's quite usual to see founders who make a lot of money move to Seattle the state of Washington has no state income tax. Nevada, no state income tax. Florida, no state income tax. Or Texas, well, actually Texas I think has a very low state income tax. So what the challenge with that is California, I'm going to be brief on this because this is you could talk for days on this issue. California has a very odd tax system, which is about 60% of the state's budget is paid by about 100,000 taxpayers. And so, and the budget, of course, is hundreds of billions of dollars. And so what happens with that dependency is that if 20,000 of those 100,000 people leave and move to Texas, Florida, Nevada, Washington, other low tax jurisdictions, the tax base shrinks enormously. And so the high state taxes has as much an effect on the recycling of capital as it does on the actual corporate income tax, which you're right, people don't pay income tax if they don't have an income, or sorry, companies don't. So the impact is quite heavy on the individual income tax side, and that's the main impediment. But it's interesting, I've never heard that phenomenon that you describe.
Alan, it could be because like none of the companies you invest in ever make a loss, right?
Say that again. There was a lot of static on the line. I couldn't really hear. That's my dream. Plenty of my companies make losses and go out of business, but that's the way of startups, as we'll hear a lot this week. The early stage investing market has grown a lot. This is a debatable point. When I first started, it was clearly a home run, or what do you call it, Tim and Kathy, a six over or something in cricket?
Yeah, hitting a six. Yeah,
hitting a six.
Don't ask me. I'm the only British person who isn't a cricket fan.
But what historically has been true is that an enormous amount of dollars that are returned to investors comes from a very small number of investments. In my firm, we did a study about halfway through my tenure there that showed that 95% of the dollars that were returned to the fund came from about 5% of the investments. So, as Tim, I think we'll talk about this tomorrow, but it is when you took your traditional finance course, you learned a lot of things that depend on distributions of data being normal. And the distribution of data in the early stage or in the tech startup, the venture capital world, are enormously non-normal. So you see here that 5% of the investments return 95% of the dollars. That's a very unorthodox sort of finance system to work in. There are two main doors for liquidity: an IPO. IPOs, as most of you know, are a rare bird, but they do happen still. The size of a company required in the US to go public now is enormously greater than it was when I first started out here 40 years ago. And overwhelmingly, as a result, the greatest number of liquidity events happens through acquisition. Or I think in some part, I think you call it trade sale in people who learn British English. And acquisitions don't necessarily mean that there's not a lot of money involved. The canonical example of this is the company WhatsApp that was acquired by Facebook for something between 18 and 22 billion dollars. The range is because a lot of the deal was based on an earnout. And that was quite lucrative. There were 50 employees in WhatsApp when it was acquired for almost $20 billion. So, people made a lot of money. As I said, the IPO door is hard to open nowadays. The Sarbanes-Oxley law in the US, which imposes a number of, I think, too onerous restrictions on companies that are publicly listed. Spitzer is Elliot Spitzer, who was the Attorney General in New York at the turn of the century, and I use him as a metaphor for attorneys general. Each of the US states has an attorney general, and each of those attorneys general is running for governor. And so you find a lot of zealous prosecution of companies as a way of claiming that you're tough on sort of illegality. So some of what Elliot Spitzer and others did in the early part of this century imposed kind of structural impediments to going public. The collapse of trading commissions, which means that most investment banks now have tiny research staffs compared to what they did when research could be sold to clients, not directly, but through trading commissions. The IPO buying community, the number of funds that buy on IPOs has consolidated. And that has the following effect, that most big funds have limits on what their minimum position is. So if your minimum position is 10% and you're 10 times bigger than you were 5 years ago, you can only participate in very large IPOs. So that a number of promising IPOs, you may not, by virtue of your internal rules, be able to participate in. And then there has been a large influx of patient capital, private equity firms, sovereign wealth funds. I don't know what you would call sort of the SoftBank Vision funds, but it's either an enormous private equity firm or a quasi-sovereign wealth fund, given the percentage that the Saudi sovereign wealth fund owns of SoftBank, that give enormous amounts of capital to late-stage private companies that, when I started 40 years ago or even 20 years ago, would have gone public. Now they don't have to go public, and many early-stage venture capital CEOs don't want to go public because they don't want to subject themselves to the onerous regulation that involves. So you see companies later, staying private longer and longer to continue to sort of reap the benefit of having the flexibility of being a private company. Next. Let's see, how are we doing for time? I think we're okay.
Yep, we're pretty much there, but we can carry on.
So how has it changed? There is more of a focus now among the traditional venture funds on risk management. That is, most funds, and we'll talk more about this during the course of the week, you'll recall, 10 slides ago, I mentioned that the size of the fund has a number of consequences for the type of company that the fund will be interested in, or how early stage the fund can invest. And for venture funds, as they get larger and larger, the focus tends to be more on risk management. So in some cases, traditional venture capitalists are becoming small private equity firms, and they will not want to invest in companies that have any technology risk or any hiring risk or any risk other than just execution risk. That is, they will want the business model entirely proven out before they invest. This has allowed, as this tier of the venture capital community has sort of risen or gone later stage, the ecological niche that they used to occupy has now been filled by what I call micro VCs, firms less than $100 million. Again, totally arbitrary, but just it's a term we'll use. And angels, or in some cases, super angels. Some of the angel investors here in Silicon Valley are multi-billionaires and have more money sort of available for investing in early stage startups than many venture capital funds do. So the terms, we'll use these terms, but you should remember that all of them are a bit elastic. So excuse me, how risky is it? We'll talk about this again throughout the week. The percentage of venture capital backed companies that fail is not precisely determinable, partly because the venture capital industry now is so big. There are so many small firms at the edge. The data that the industry generates, even with an increasing amount of effort put on sort of kind of aggregating the data and making it available, it's still a very opaque industry. And so the data are sort of largely anecdotal. My best guess, and certainly true of my old firm and the firms that I know, is that about 40% of the companies that are invested in fail utterly. That is, there's no return of capital, they simply go out of business. 40% return some moderate amount of capital, somewhere between sort of half of the capital invested to maybe twice the capital invested. And it's 20% or fewer, probably fewer, that produce the kind of high returns that both make up for the losses and also generate enough returns for the investors in the venture capital funds that the partners in the firm can raise their next fund. So a rule of thumb I mentioned a couple of slides ago is that 5% of the deals provide 95% of the dollars returned. So you can see it's a highly non-normal distribution of data, which makes a number of things, including valuation, as we'll talk about later in the course, much different than the valuation sort of techniques that you used in your other finance course. Next. Late breaking trends. Corporate venture capital is growing. Not clear it's a good sign or a bad sign. The whole sort of issue of corporate venture capital is a sort of a complex one, and we'll spend a bit of time on it, but we could spend a whole course on it. The Global 1000 have discovered Silicon Valley. As you drive around Silicon Valley now, you will see sort of logos out in front of buildings of you would think, very strange companies that don't have much to do with technology. But many of the Global 1000 now have open research facilities here because things like artificial intelligence and machine learning, robotics, and even quantum computing in some cases have applications to a huge variety of different kinds of businesses. I mentioned this a slide or two ago. There's a new large and still inexperienced pool of capital flooding in. The Saudi Sovereign Wealth Fund is probably the most prominent. There is a lot of money coming in from sovereign wealth funds in Asia and other large agglomerations of capital from Asia. You see occasionally the Norwegian Sovereign Wealth Fund poking around in deals. And as I mentioned, SoftBank and its $100 billion Vision Fund, which has received a lot of critical attention recently, is an important factor that has really altered some of the rules of early stage investing here in Silicon Valley. You will hear a phrase called the Series A crunch, and we'll talk more about that throughout the week. But there are a number of factors that have come together to make it easier to start a technology startup. Number one, the amount of capital that you need for computing devices and for storage devices and for software has shrunk enormously. And it has not only shrunk, but most of those costs have become marginal instead of fixed. So 25 years ago, if I were doing a startup with Tim and Kathy, we would have to spend $1 million or so buying a large Sun server computer, probably $1 million buying a big storage device from EMC, and as much as $1 million from Oracle to buy and implement an Oracle database. Today, we wouldn't buy any of those from any of those vendors. We would buy everything from Amazon or from Microsoft or from any of the other cloud service providers. In addition, if you're a software company, most of the software development tools that are used these days are open source and therefore either free or very low cost. So the cost of doing a technology startup has shrunk enormously. No surprise, the number of startups that have been formed has exploded. But the number of venture capital funds that invest in early stage startups has not exploded because venture capital firms don't explode. You know, it's very hard to raise a venture capital fund, especially if you're doing it for the first time. And so there's a big lag between the number of startups that get formed and the number of venture capitals firms that get formed to invest in those startups. So if you will, the top of the funnel has broadened and the bottom of the funnel, while it is expanding at a much slower rate. So a lot of a lot of startups that are formed don't get funded simply because there isn't enough attention among the venture capital community to sort of encompass all of those startups. So that is a term you'll hear a lot, a Series A crunch. We done? No, okay.
Yeah, and that's it actually, Alan. So I don't know whether we're running at just 10 minutes over, but if there's any questions anybody's got at this stage, do ask. I've got one coming in from Bioli saying, do you invest in Oxford spinouts? And are there key differences between Oxford and Silicon Valley in terms of angel VC investing?
The answer is most of my investing now is done through my venture fund. And most of our attention is on US companies, partly because it's so difficult for a US venture fund to participate as actively in a company that's located elsewhere. There are, I would say, some differences, but the differences are shrinking. I think the venture capital business is very slowly becoming a global business. But I think it will always remain somewhat local. And the reason is an early stage investor, a venture capitalist who wants to put the first money in or second money in a startup will want to be actively involved in the startup, not making operational decisions, but making sure that it's not going off the rails, because startups, because they travel at such a high velocity, can easily jump off the rails and crash down, into the ravine. And so there will always, I think, be in early stage investing an attraction of investing in your local area, and that's part of why Silicon Valley has been as prominent among these startup clusters as it has been. That's different later stage. Later stage, people are less concerned about being close to their companies because the operational involvement or the level of involvement tends to be less. So you see a number of European funds investing in late stage companies here. US private equity firms are quite active in Europe. They're quite active in Asia and Australia. So early stage, being local will be more important than later stage. But I would say there is a gentle, slow trend to lessening the importance of being local.
Yeah. Now we've got another couple of questions, but I'm inclined to park those because Alan's going to be around for the rest of the week, and I've realized that we've got 2 sessions after the break. So our final session of the day has got 2 guest speakers, Cal Henderson, and then we're going to do a case study with Jeff Lewis. And so I think we should take a break now for 15 minutes and come back at the top of the hour. Just to reiterate though, this is your big chance, right? So you're going to get to, you know, be able to ask questions of one of the founders of Slack, and we're going to lead that off, but it's your opportunity. You've got an hour and that's it. And so, you know, do post questions in on chat or whichever you prefer. This works quite well, I think. And then after Cal, we'll be doing case study. So if you haven't, I hope you've had a look at the guidebook case, but if not, you've got 15 minutes to catch up on it, and we'll go straight into that, and we'll be sort of, to some extent, quizzing Jeff a bit on the decisions he was making as a young entrepreneur, about this sort of speed versus keeping control aspect. So how much money do you raise? How quickly do you do it? And we're also then going to look at the convertible note issue that actually Alan invested in as part of the angel round for Guidebook. Okay, so if you have got 15 minutes while you get a refreshment, just get Guidebook up in front of you, please, so that you're sort of, you know, so you know what you're talking about.
And we hope that Cal will be with us as soon as we come back. So if you can be prompt. And just another nag, so when you've got a guest speaker, I think if they can see you and if you've got enough bandwidth, it really makes a difference. So we'll call people we can see, but we'd love to have, even if you've got kids in the background, we know you're with us if you've got your, if you've got your picture on. So when we come back, particularly for guests, but well, for us as well, but if you can bear it, please show us the live version of you. Okay.
Yeah, because we won't have any presentation, so you will be there will be a screen, and it's better to free a screen of faces.
Exactly.
Of names.
If you'd done this yesterday, you'd have a lot of my 2-year-old granddaughter running around my office.
Good.
Okay,
so
see you in a few minutes.
We'll take a break and come back at the top of the hour.
Here, I think we've many of them have, depending on where they live in the world, might not be able to have their camera on. But those of you who can put your camera on, do put your camera on, particularly if you want to ask Cal a question. So this is going to be, an opportunity for, I think, everybody in the group to relentlessly ask Cal whatever they want. It's not just for Tim and Alan and I to ask questions. And I suppose just to start, Cal, my first thought was, since we spoke in March, there's been so much use of Zoom, so much use of, online communication. And Slack has done very well, but not sort of taken massive advantage of that. So I'd like to sort of get a snapshot from you of how you see things now, but then go back to the beginning to when it all started and tell us a bit about how it started up. But at the moment, what's it been like during this period?
Yeah, I think the thing that sets us apart from Zoom, and Zoom is really kind of like a unique case of their incredible growth during COVID, is that when companies started to shift everybody to working from home, everybody already knows about video conferencing. It's not like it's new technology. It's been fairly ubiquitous in the workplace for 20 years, although in varying quality. We moved from like the Cisco virtual rooms that cost $1 million a piece through to when Blue Jeans and that kind of second wave of video conferencing commoditized, kind of peer-to-peer video. We'd had it with Skype for a while, but it really started up in the workplace in a different form. So this is ending up about a history of video. But when FaceTime came to iPhones, and people were like, well, we can just do web-based video, and this will replace, really expensive meeting room technology. And that was kind of a commodity for a little while, for 5 or 6 years, and then Zoom came around with just a better experience. And there's a lot of interesting stuff to read about how the experience is better on top of what people thought really couldn't particularly be improved, or there wasn't a lot of room for improvement. their growth is unprecedentedly large, and in a way that has been both good and bad for the company as well, because it's being used for non-work purposes and schools and social, and incredibly difficult for them to turn that into profit, or ever have paying customers from a lot of those audiences. For us, when COVID started, we saw a big spike in demand of new customers. And that was true probably for about the first month. We saw a big rise in new customers coming in, and then it settled down to a baseline significantly above where it was kind of pre-COVID. But I think the big disadvantage we have compared to Zoom is that most people don't understand the product category that we sit in, because it's a new category that people aren't specifically looking for. And so for us, I think it was just much more of an acceleration of people who would have thought about trying Slack, tried it sooner, or who understood that this was a product category, tried a tool that fits in that category. And so it's been definitely an acceleration for us on the new customer side, but at the same time, kind of macroeconomic environment means slower expansion, as our customers are all kinds of companies either laying people off or going out of business, and that affects our business too. So two countervailing pressures there.
Alan, sorry to interrupt. It's Alan Morgan. Thank you for your time. I would also think that going from a office-based work environment to a distributed-based work environment would have less of an effect on a company like Slack, because to go from an office-based environment to a distributed environment, you don't need to do anything if you're a Slack customer. You use Slack when you're in the office, and you use Slack when you're not. Whereas Zoom, you have a whole new mode of working that you need a new application for.
For existing customers, I think that's true. Although we did see, for all across our existing customers, we saw an increased number of minutes spent using Slack per day. So it would have previously been some amount of interaction through Slack and some amount of interaction in person, and that in-person piece went away. I think the more general trend that we saw, and the Zoom saw, is that for many organizations, they had to switch very quickly to working from home, and they'd never really thought about being remote, fully distributed organizations before. And so they tried to take everything that they did in person when they're in the office and move it online. And so they weren't, it's like, we have meetings. Meetings are the way we do business, are the way we get things done. How can we continue to have the same meetings now that we're not in the same room?
How true, how true.
Yeah, and of course that's what people do, because it's, they want to continue working as they have worked before. I think what we see less of, though, that is probably kind of more interesting, is organizations, companies, teams taking this as an opportunity to think about how they can work differently when they're distributed, as opposed to how they can emulate the physical office while distributed. But that's a whole bunch of work, and it was already a turbulent time for customers.
Yeah,
that's one of the ways we see it internally, is that since this is such a big change for everyone, like, take advantage of that crisis and use this as a time to change how we work as well. Because if everyone's working lives are already severely disrupted, then it's less of a hassle to disrupt it a little bit further.
So you are now a public company, and you went public last year with a pretty hefty sort of valuation. I think it's at $20 billion. Yeah, something
around that.
But that's a long way from when you started up. So can you give us a sense, that the students on this course are looking at how you make that journey from, finding your first angel investor to getting to, Series C, D, E, and IPO. So give us a sort of flavor of how it happened. And I know that, you already teamed up with Jason Butterworth, who was a successful entrepreneur, but just give us a flavor of that journey.
So I'll do the short version of a long story. I've been working with there are 4 co-founders. I've been working with them since the very early 2000s, 2002. we first started out trying to make video games. That didn't work out, and we turned it into Flickr, the photo sharing website that was acquired by Yahoo in 2005. We went back again and tried to make video games, and that didn't work out, and that turned into Slack. So the company that's now Slack started 11.5 years ago to try and make online games. And at the time we started that company, we were trying to kind of realize our vision that we'd had 5, 6, 7 years before for the particular thing that we wanted to build. We had quite a lot of advantages the second time round versus the first time, because we were a kind of a proven team, because we'd built Flickr and successfully sold that company and grown it to a certain scale. But also we had just a much better kind of network in the Bay Area, having moved to the Bay Area as part of our acquisition. So we had good relationship with a few different investors here, and that's how we raised our initial kind of angel round, and then our Series A and even our Series B, as we were building a gaming company, was through people that we already had existing relationships with. So it was very much, especially if you talk to our investors now, they were investing not in the particular idea we had, and maybe it was a terrible idea, but just in the team, because they had experience working with the team. And in fact, when did we started? 2009. Our investors didn't necessarily believe in the market that we were going into, which was kind of online web-based social gaming. Although at the time that was really taking off with kind of the rise of Zynga and Facebook games and that kind of era. But we made a bunch of mistakes and kind of missed some big coming trends, especially around mobile and how a lot of kind of casual gaming play switched to mobile. So we ended up spending 4 years working on this game project that ultimately, by the end of 4 years, it could have turned into a lifestyle business. It was successful enough that we had some revenue, but not that we were going to be able to kind of make back the investment that we'd sunk into it and turn it into a successful business. And so at the end of those 4 years, we realized we needed to spin the game down and the company down. But we went back to our investors. And at that point, that was Andrew Bratcher from Excel and John O'Farrell from Andreessen Horowitz. And we went back to our investors, and because we had a little bit of money left, we wanted to wind down the company before we ran out of runway completely and couldn't pay people. And in that process, the investors didn't want the rest of their money back. We only had a little bit left. They were on both sides pro us keeping that money and seeing if we could do anything with it. And so we shrunk the company from about 50 people down to 8 and tried to figure out what we were going to do next. And in trying to remember that period, in my mind for a while, it was like months spent going back and forth and lots of different ideas. But we have a log of the whole conversation, and it was about 5 days in which we tried a bunch of ideas and decided what we were going to build was ultimately what the tool that became Slack. And that was based on the tools that we had built ourselves for ourselves while making the game. So we decided that's what we were going to try as a business.
Was there anyone in the team who wanted to kind of hang on to the old business? Because that pivot and the ability to move away from that, as you call it, a lifestyle business, which is doing okay, but not going to make your fortune, is a difficult one. And we're going to talk more about that actually as the next few days continue. But
I think, you know, it was definitely the worst kind of outcome, because if something's an outright failure, then it's much easier, or if it's a runaway success. If it's like a kind of middling success, I think that was why we ended up doing it for 4 years instead of say like 2.5 or 3, which would have been a healthier way to look at that business, was because it was so close to becoming successful. It was like, oh, it's doing okay, and maybe the next thing we do will make a big enough change. You know, maybe the next tweak that we make in how we position it or how we onboard new players would be enough to change the trajectory enough. And so it sat in that kind of, in retrospect, it was like it wasn't going to be successful, and we can see that now, but it really felt like it was just on the cusp of us being able to turn that around. And it would have been much better if it was just more of a failure. But I think that, you know, the founding team, the wider team that was building it, and definitely our player base, was very kind of invested in it. But I think the founders, the management team, it was clear that we weren't going to be able to turn it into the kind of success that we needed to be able to do to justify how much of our investor money we'd spent on it.
Sure. And you already, through Flickr, you already had good relationships with key investors who believed in you. But as you started to build Slack, what were the things that you really learned about dealing with those VC investors that were surprising, or or things that have really made a difference to, as you went from round to round of funding? What were the key sort of lessons? And then everyone, if people want to chime in, just put your hand up in the put your hand up in the participant folder, or ask a question in chat.
I think the reason that we picked the investors we did at different stages was obviously not just about their money, because everyone's money is the same, assuming you can get the same terms, but was really about their other portfolio companies and their expertise and what they've seen happen. And when we got advice from our, and for our first three rounds of investment, we bought on. Those came with board seats too. So we had our VCs on our board. So it was my co-founder, the CEO, was chairman of the board, and we had our first 3 A, B, and C round investors join our board. And they all had slightly different perspectives depending on their previous investments in enterprise software. And I think the biggest thing for us was we had never done enterprise software selling to businesses before. All of our, both Flickr and all of our kind of experience before that was on the consumer side, building consumer products, and that's the kind of the strategy we used at the company for how we built the product and got to where we are today. And the investors, all from slightly different perspectives, were all oriented around what we should learn from other companies that have come before us, and where we were, what we would have no hope of doing that we believed we could do, and what we would, what we'd be able to do, and what our gaps were. And we definitely not fought against our investors, but they definitely didn't believe that we would be able to have the success that we have since had with our approach, because we weren't taking the usual enterprise software approach, which up to that point had really been building and trying to sell to the CIO, trying to sell to a VP of IT rather than trying to target an end user. So we were taking a different approach, not necessarily because we believed that that was a better way to sell software to businesses, because we knew nothing about selling software to businesses, but because that's what we knew how to build. And so that's the approach that we took. But in terms of...
I was going to say, Kat, can I ask a question in terms of...
And then we've got a question from Shira as well.
Yeah. So in terms of, you were sort of almost out of money, but not quite out of money, but presumably building Slack took quite a lot of new developer time and all that sort of thing. So did you have to then raise another round there for this sort of pivot company at that stage?
No, not well. So when we stopped developing the game, we had about 50 employees, and we had less than a year's runway. But when we went down to 8 employees, we then had a lot of runway, because it was just a lot cheaper, and we got rid of one of our offices. We only had one small office globally. And then we just had quite a lot of runway. For the first year that we were building Slack, I think for like the first 9 months, we hired nobody. It was 8 people, and then we hired a couple of people after that. So we just kept the team very small and lean, and kept our burn very low. And in fact, when we raised our third series, our Series C, which was after we built and launched Slack, we didn't need the capital at the time, or we didn't immediately need it. We weren't about to run out of runway, and we had revenue. That was a long time before we got to cash flow positive, or free cash flow positive. But it was really about bringing the expertise on board, and as in a lot of our subsequent rounds, because we raised a lot of money before we went public, was about future optionality should we need it. So ability to do strategic acquisitions, or to accelerate kind of hiring and spending ahead of our revenue growth, and much less about like we need to extend that runway to be able to survive. I think that it was haven't really thought a lot about this, but I think it was wise for us in retrospect to try and just keep the team very, very small as we iterated on the first version of the product and started building our customer base. we also didn't think we would ever get to the scale that we're at today. So we were building a product and a company for a much smaller kind of end state than we now got to. And we were imagining, you know, we would be able to, we talked about one day being able to, in the, like, over the next decade, if we did everything right, get to a business with $100 million of ARR, and we hit that in the first year, I think. So on the one hand, that sounds like we did a really good job. I think it's better to look at it that we didn't really understand the market we were getting into, or, you know, what the kind of possible TAM was.
Yeah. Just one final one, then we'll take some questions. But for your type of business, does growth take capital, in the sense of, you know, the revenues are very back-loaded, so the more successful you are, the more capital you need the sort of more money you lose in the short term?
Yes, although not in a direct way. So nearly all of our, we definitely say a lot internally, if we can spend $2 now to make $1 of ARR, so it'll take, you know, 2 years for payback period, like a 2 or 3 year payback period, we would spend as much money as we could, because we're cash rich now. But we have, it's been incredibly difficult to find scalable ways of spending large amounts of money to convert directly into ARR. Nearly all of our expenses are personnel, so it's really about early on heavy R&D expenses, which is incredibly difficult to tie directly to you know, to revenue, but is really about building the product now that our customers will need a year from now or 2 years from now. Some of that is also just about building for scale. It takes a lot of R&D investment to be able to support millions of customers. And then on the slightly easier side is building a sales force ahead of where they'll be able to actually close sales. So we look at, you know, the payback period on both of those. Much easier on sales, because you can just model that out directly. You know, it's like when we bring on an account executive, when we bring on a salesperson, here is the ramp period, you know, before they make any revenue, and here's when they start to make revenue, and here's when the payback period hits. And that's all, like, but that isn't a, for every dollar we pour in, we get this many back over 3 years, because there is a natural, you know, kind of market size. And if we hire too many salespeople, then they won't have enough people to sell to. And if we don't hire enough, then, you know, we have to find that right balance. And there's quite a lag between deciding we want to grow the sales force and those people being online and productive.
Well, I know it's hard to spend that much money, so I'm emailing you with several suggestions and account numbers.
Yeah. I was going to say the entire class will be doing it. So should we have our first question from Shira?
Karen, yes, thank you. Thank you, Cal, for coming and speaking with us. You know, it's great to see your success. So you touched on this a little bit. With tech companies that have missed out certain spheres of the market, I know that Slack is planning to grow a lot with acquisitions going forward. Your CEO announced that. Is this a general trend you foresee in the wider tech space post-COVID, where valuations are very low, and you know, companies like Slack that are growing are going to continue to acquire other players that markets they want to get into?
Yeah, and I think that has been a general trend over at least the last kind of 20 years in tech, is that prior to COVID, valuations were way too high, and it meant everything was super expensive. As they start to come down, we'll see a lot more of that, and it's you know, going to be one of the, for larger incumbents, will be one of the advantages of the kind of economic downturn. Is that for larger companies, we're not particularly large yet, but we're, you know, mid-size enterprise. For larger companies, using startups as basically outsourced R&D is like good value for money, as long as you're not paying ridiculously over prices as it would have been 6 months ago. And I think one of the reasons for that is not because large organizations find it hard to iterate on new products, although they do, but because it's distracting. And so you instead have small companies who go out and build and iterate on interesting things, and then you pull them in when they, you know, pull them in via acquisition when they reach a certain stage of maturity. Not because you couldn't have used those same dollars to fund an R&D effort on the side, but because every time you do that, it's distracting from your core mission. And so it's easier to essentially, you know, if you think, say you spend $10 million for some small technology acquisition. And really it would have cost you, say, $2 million to do the same thing in-house if you hired the same number of personnel and went after that. What you're essentially doing is funding 5 versions of that, one of which are successful, and then you bring it in once it is successful. And I think that's one way to look at it as an acquirer, and that you don't have to worry about that, and you don't have to think about it, and it doesn't distract from what you're doing until the point at which one of them finds some amount of success.
Charles, I think you're next.
Yeah, I mean, this is a question from a very old tech geek. If I look at Slack, it looks a lot like MIRC, IRC chat rooms back in the 90s.
Yep.
Did you get your inspiration from any of that?
Yeah, absolutely. Yeah, it's all inspired by IRC, and we were all IRC users in the 90s, and we used IRC through when we were building the game as well. And we, that's where the channel model and naming comes from, and I think we saw that concept as we find it a very effective way to communicate as an organization. But IRC, although it was mid-80s that it was created in, and just never had many users because it was so difficult to use and missing lots of kind of key features. We were like, what if we took this model of how people communicate and make it accessible, fix a lot of the kind of missing feature gaps, and then pull it together as a product? So it's really the capabilities that developers had for a long time for normal people.
So just to follow on that, so did you actually because you said you had a bit of cash left and you're kind of looking on what to do with it, because like fashion, innovation tends to repeat itself in cycles and ideas tend to kind of recycle themselves. Is that how you went about, okay, we've got a bit of cash, let's go and look at what sort of things we can recycle, reuse with better technology, and then monetize?
No, we weren't nearly that clever. Kind of what we were was we looked at the way we had been working together as an organization, realized that whatever we did next, we'd want to keep working together that way, and so maybe other people would too. And it wasn't, we had already built to the kind of proto Slack to work on the game, and we realized that we wanted to keep using it. So I think, in retrospect, we could frame it as that, but really it was just, we have already built this thing, let's turn it into something.
I just wonder if you could say something about your journey as an entrepreneur, because you've spoken previously about how when you lived in the UK, nobody would give you a chance, and then you came over to the US, and suddenly it felt completely different. But I'm sure it's a more complex series of steps than that. But we've had a question already before your session on, Alan's sitting there in Woodside saying, well, Woodside and Silicon Valley, Palo Alto is the place to be. And many of this group are sitting all over the world with their, their business ideas. And so what would you say to them?
Yeah, and so this answer is kind of ignoring the current state of the world in which location is not nearly as important anymore.
You can have a two-part answer if you like. You can answer and then do the COVID answer.
I think it's much less that when I was I was born and grew up in the UK, it's much less that nobody was willing to give me a chance, and much more that I grew up in an environment where entrepreneurship just wasn't a topic. It wasn't a thing people did, and it wasn't the default. And I think to the extent that people did think about starting businesses, they were viewed as strange outsiders. And the British attitude towards trying something new and different is like, you're probably going to fail, you should just get a real job. And then when you do inevitably fail, because nearly everybody, starting a new business does fail, then it's, oh, I told you so. Of course you were going to fail. Why did you try something new? When I came to the Bay Area, the really big difference, there's, the big difference between the Bay Area and kind of everywhere else that I've worked, especially London, is not that there's access to capital, although there's incredible access to capital, and it's not that there's, great education nearby with Stanford and Berkeley, but that definitely helps. But it's really about kind of attitude towards risk. It's that in London, people would say, the kind of prevailing thought would be, why would you do that? Of course you're going to fail. And in the Bay Area, it's, of course you're going to fail. What have you learned and what are you going to do next? And of course you're going to try something again next. And it's self-fulfilling prophecy in the Bay Area as a location, because if you come here and do a startup or do a couple of startups and fail and you don't want to try again, then you leave. And so the only people here are the people who are starting startups for some value. And that is, it's really because of the kind of the history going back to like Fairchild Semiconductor and Intel, of there's many generations of successful entrepreneurs who then kind of reinvest in the community, kind of like from a time and guidance, you know, and advice and support way, that you're just surrounded by a very large community of people who are interested in taking risks and investing, and you know, see that as a you know, like from the venture capital side, is you invest in 10 companies or 20 companies and one of them is successful, and that's great, and that's what you're looking for. So of course you expect most companies to fail. And when companies do fail, you then start another company and see if that works. And it's just such a different attitude to be surrounded by people who are like embrace failure, learn from it, talk about it, and then try again. It's just a very different environment that, and that's, I think, the hardest thing about the Bay Area to replicate, because it's built on this kind of strata of successful and failed startups over what is now 50 years. And that's the hard piece to replicate. I don't know what that means in the current distributed version of it. And investment, you know, and Sand Hill Road used to be so oriented around being here physically, you know, and that's why Y Combinator brought people here physically. So many startups, you know, like people move to the Bay Area to do a startup. I don't know what that's going to mean in a virtual environment. The people you're surrounded with, it's no longer the people you're physically surrounded with, right? It's the people you're on Zoom calls with.
And I suppose it depends how long this whole situation lasts. So, Steve, I think you had a question. Steve?
Sorry. Hi, Cal. I was in two minds about lowering my hand because it's sort of in a similar vein. So I'm just about to launch a new startup. And I wondered, so I'm fortunate enough to live in the Cayman Islands where there's no personal income tax or corporation tax, right? So it's quite tempting to just set up the company here.
Yeah.
But with all the discussion about the benefits of the ecosystem in Silicon Valley, would I be handicapping the company to set it up in the Cayman Islands compared to setting it up in, at least incorporating in the States, like Delaware, or should I just, you know, should I ignore that?
Yeah, I feel like that's a couple of different questions, because nearly every successful startup in the Bay Area is incorporated in Delaware. So where it's incorporated, you know, is definitely not the same thing as where it operates and where the people are. I'm definitely not a lawyer and I can't give you tax advice, so I don't know. I don't know of any other startups that are incorporated in the Cayman Islands that have then been successful, but it probably happens.
I guess it's more a question about would it put investors off, or would it put customers off?
Potentially, and that does mean that there's more hoops to jump through for sure. I mean, it's not the same as it being incorporated in China with the current Chinese venture investment laws, but there's probably I would definitely take advice from somebody who knows on that topic. But I think in terms of the physically where you are, it definitely would have previously been a handicap unless you're in the Bay Area. I think that's definitely changed since the start of COVID, because it's irrelevant where people are right now. And the big disadvantage to the Bay Area is cost of talent, and to a lesser extent cost of commercial real estate, but especially cost of talent. That's going to, like COVID, depending on how long it lasts here, is going to have such a big impact on that piece, on organizations being more distributed and you being able to be in the Bay Area without having to pay the tax, you know, the like 50% to 100% extra tax of hiring engineers here.
There's such a relentless sort of drive for growth, particularly when, you know, you've got shareholders wanting to have increased returns all the time. How different is it for you now? And do you, to some extent, lose some of your enjoyment that you had at the beginning when you were, you know, you made the bet on doing this, you know, okay, the gaming company is no more, we're just going to go for this, and all that sort of excitement of a startup, even, you know, well-backed startup, which yours was. Now it's very different. You're running a company where everybody's looking to see what they're going to get out of it, and you have to report back, and So how different does it feel?
I feel like you definitely asked two different questions there, because you said, how different does it feel and is it still fun? It is very different. It's incredibly different, because I think we go through, in terms of, there are kind of three things you build when you're building a company, assuming it's like product or services kind of company. The first thing that you build, and that we spent the first couple of years building, is the product. The thing that matters, and the thing that's first and foremost is like, are we building a thing that we can sell? Are we building a thing that people want? And we concentrated on that for a couple of years. The second thing that you build then is the business. Can we sell enough of these? Do the unit economics work? That this is a sustainable business? Is it, or are we charging less for shared rides than we make back on them and have to pay drivers or whatever? Do we have unit economics there? We're enterprise software, so that's very straightforward. And then the third thing you build kind of long term, which is much less tangible, is the culture of the organization. And you do that whether you're intentional about it or not. And I think that's while the product piece is definitely still very interesting, and I love building software. That's why I got into it to begin with. And then the business piece is less interesting in enterprise software, because it's a lot more straightforward, relatively speaking. Then there's how can you build the kind of company that I still want to work at a decade from now? Because having worked at other large companies in the past, many large companies are terrible places to work, not because of reasons, not because people tried to make it a terrible place to work or didn't want to do good work, but it's so difficult to. If you've ever tried to go out to, back in the olden days when you could go out to dinner with friends, if you've ever tried to go out to dinner with a group of like 5 friends and choose a place to eat, that's an almost intractable problem. And it's like, try and do that with 10,000 people, and you'd not even, and it's not everybody even wants to go to dinner, and nobody's sure what they want to do together, and some people are only there to get paid. And organizational dynamics are hugely interesting. I think that's what's interesting about my job now, is so different to what it was a decade ago when we're starting out, or even 5 years ago, that it's really about organizational dynamics, execution, delivery. Very different. And I think when there were 4 co-founders, one of them has retired now, but one of my other co-founders, who isn't the CEO, is an engineer still. He just writes code, is on one of the many engineering teams at Slack, and for him, his job hasn't really changed. It's just a larger company has grown up around it, and I think that's because that's what he enjoys doing and how he derives kind of satisfaction and reward in the workplace. I have over the last decade really had to change how I get kind of energy and reward from what I do for my job to still be fun as it evolves, because what I do now day to day is just so different than what it was 5 years ago. But very long rambling answer, but really I find it fun because it's a really big challenge still, and it's a challenge of a new set of things that I don't know how to do necessarily. So.
Yeah, well, I think you've talked about that a lot in the past, and you really believe in the sort of the culture of the team being important for the company. I think I'll bring in another couple of people with questions. Fabian first.
Hi, Carl. Thank you for your presentation. So the question is that you mentioned that during the Series A and Series B, you were looking for bringing some investors into your board. Can you explain a little bit more what are the things that you wanted to get from them, and did you get it?
Yes. So our Series C, we bought in social capital. And that was originally Mamoon Hamid, who joined our board, and then after he switched to a different firm, we had Chamath Palhapatia, who is a real character, was on our board for a little while. He's left now as we've become a public company, and their experience was largely oriented around Facebook and Facebook's growth and understanding how they. So we were definitely an enterprise company, but really wanted to understand how we could better take advantage of the kind of viral nature of what we were building and how we could get it to grow within organizations. And so that was the expertise that we were looking to add there. As we then took on further rounds, it was, in a later round, we took investment from SoftBank because we really wanted access to an expertise in Japan as a market. Japan is our now our second largest market globally. We really wanted to understand how we could sell into that market in the enterprise space, and that was a lot of expertise they had. And each round was not, in fact, none of those kind of rounds subsequent to our Series C were about we need more capital. And in fact, we, from Series C onwards, our kind of our cash reserves had never dipped below the how much money we had in the bank at that stage. So it was really just about adding cash for optionality and adding expertise to our board. And it was all about different areas of expertise, selling into different markets, selling into different kind of stages of business, if that makes sense. Sorry, my kids are shouting in the background if you hear that crosstalk.
That's okay. I need to apologise. I don't know if anybody heard, but the local pub opposite my house decided to play loud music. So it doesn't sound like any of you heard it, which is good, but it was blasting out 1970s music a moment ago. So Sohail, I think you were next.
Yeah, thanks, Kathy. Hi, Cal. I think you raised some really interesting points about attitudes. And I would agree that growing up in the UK, you know, if you're pursuing an entrepreneurial career, it's kind of frowned upon, and you're expected to have something more traditional. But in the last 10-15 years, do you see that trend changing a little bit? Because, for example, in London, you've got is it the tech city, the Old Street roundabout area, and there's lots of like tech companies that are emerging. And you know, there's plenty of universities in London. And I would say millennials are certainly probably more, you know, risk-taking than previous generations. So do you think that trend is changing? And do you think, you know, whilst places like Silicon Valley have a head start at the moment, that cities like London are catching up quite fast?
So I would take with a grain of salt any of my answer, because I've been in the US for the last 15 years and I was in Canada before that, so I don't really know. But definitely that kind of, I was very aware of the movement around Silicon Roundabout, and that, however, that term was coined by a friend of mine who's been out in the US for the last decade in the Bay Area and lives just down the road from me. So a lot of people, certainly from that kind of 10 years ago, London tech, are either now working for the government or have retired or have moved here to the Bay Area. And so there was definitely a good trend, but I don't know how much that has been kind of more visible to me versus an actual change in attitude in the UK. I think definitely the rise of successful consumer tech, not in the UK, but just globally, like the visibility of like Facebook and Instagram and Snapchat and TikTok, and really the rise of the smartphone and the App Store, I think has given people a different orientation towards entrepreneurship, because in many people's minds now, entrepreneurship is like, I could build an app and that's a business. And that seems a lot more socially acceptable than starting a company was 20 years ago. And so I think that's given some accessibility to the tech space. But I couldn't really tell you about what the actual trends are. You know, I'm involved in a VC in the UK, and definitely the investment market there is so small compared to just the Bay Area still. For even the whole of Europe compared to the Bay Area is just small.
And what kind of things are you investing in the UK, Al?
Interesting tech companies where I can add value. You know, same as I invest in kind of anywhere, which is, I think it's you know, I love making software. I'm not necessarily any better at figuring out what's going to be successful than anybody else. And so founders that I like and that I think I can be valuable to is, you know, the kind of companies I get involved with.
Okay, you're not going to mention any at this moment. So
no, I mean, no successes that you've heard of. So
yeah, okay. We've got another question from Balai.
Hi, Carl. I know that you are very, very good software engineer, and at the early stage of the startup, can I just ask a little bit of a personal question? When you take your salary of your founder, are you taking less salary than market rate, or higher, or more or less the same? Like
oh yeah, throughout kind of all of the time when we're a private company, I took less than a market rate salary. At the same time, I didn't have kids until 5-6 years ago, and so that might be different if I did it today, you know, if I was in the same situation. And so I think historically as an organization, we had a kind of like compensation philosophy that's very common in the Bay Area of everybody who worked for us got equity, but we also had to, you know, pay market rate salaries, or as much as we could, which is very high in the Bay Area. But the founders just took less pay, and like many, you know, all of the early employees who worked for us got more cash than us, but we, you know, really paid ourselves as little as we could to live comfortably, and you know, we were more than anybody else gambling on the, you know, future success of the business to compensate us, which is great when it works out.
Later on this week, we're going to come on to sort of talking about term sheets, and Alan is going to say a lot more about that. But one of the questions that often arises when Alan does his session is, you know, well, how much should you argue over a term sheet, and how much do you have to think about being, you know, having a bad deal done during that term sheet negotiation? Alan, feel free to come in here, but just looking ahead to what we're going to be talking about later in the week, we may as well take advantage of the conversation with you to get some feedback.
Yeah, we were in a very lucky position that when we raised our first round, you know, we had a good relationship with our investor there, and every round we managed to have a fairly clean term sheet with, you know, I guess there's no objective measure, but in terms of like, you know, ratchets and strange liquidation preferences, or, you know, we did a convertible note on the first round, and then kind of regular raise after that every time. And we were just in a position where we were able to set the terms generally of, this is what we're looking for, this is the valuation we're looking for, are you interested? And that was, you know, like in our early rounds, that was a little bit of a negotiation. In our later rounds, it was much more around playing investors off against each other and being able to get the valuation that we wanted, but also control the valuation, because we didn't want it too high. Like the more it grows, obviously the more it sets expectations. Every time your valuation goes up, that's another thing you have to grow into. And so we wanted to balance dilution versus you know, how much cash we really in each subsequent round. It wasn't really about how much cash, it was much more about controlling valuation and getting the investors on the cap table that we wanted, and then after some point getting old investors off the cap table because of all of the weird restrictions when you hit 100 owners, whatever those laws are in the US. I'm sure you'll get into that. That's all horrible.
Well, I was going to say that your answer has just touched on practically everything we're going to talk about, that Tim and Alan are going to talk about in the rest of the course. So pay attention, everyone, because there'll be a short test coming later. Alan, I don't know if you want to add anything here. I just thought, well, we've got Cal, we'd look ahead a little bit before we get to the next.
I think that Tim and I can take the rest of the week off, and Cal can just teach the course.
Yeah.
Yeah, I think one thing I was going to pick up on is, which I think is fascinating, is, and people should look at, is this idea that you want to manage your valuation. In other words, so presumably another way of stating what you said, Cal, I think, is you didn't want to have a down round at some point. Is that a good way to put it?
Yeah, well, that's definitely one part of it. You know, we never wanted to have a down round, but the other part is that, you know, when you raise many times, people look at your kind of valuation over time. And if you raised 9 months ago and this time you raise money and you're 4x valuation, if you're not 4x the valuation next time you raise, then even though it's far from a down round, like if you were only twice the valuation, then it looks like a slowing momentum, and you don't want your momentum to look like it's slowing. But also you want to be pretty sure that you can grow into that valuation someday, because yes, it's great, you've raised money, you look like you've reached some kind of success, but if you don't believe you can ever drive revenue to ever make that money back, then you're setting yourself up for failure. And in terms of, you know, when you look at the valuation of private companies, we were at least not pre-revenue. You know, we were charging money, and so we had revenue, but still it was so many years of forward-looking revenue at the scale that we were at, that if we weren't kind of growing significantly, then that was, you know, we're looking at you know, like 50 years forward revenue as a valuation of, you know, if we can't grow into that, then even though we might have had a really successful business, by raising at that valuation, we were never going to be successful, because we will never meet that valuation. And so we want to be really careful and control that, and balance the kind of market demand and what people thought we were worth versus what we believe that we could reasonably be worth.
We just got time for a couple more questions. So we've got Augustine and then Nick. And if we have time for a third one, we'll get one in.
Kathy, one quick thing, just not a question, but we will talk, just for the class, we'll talk later this week about the the impact of what Cal just said, which is what happens when you have a high valuation, which usually involves a heavily structured deal, and then your next round isn't an up round, and who gets hurt. So yeah, we'll continue that conversation.
So Augustine. We're having the dark
roboty. I would try turning your video off and seeing if we can hear you better.
Should have used Slack.
Try again. No, I'm afraid still can't hear you, Augustine. I'm sorry.
Why don't we go to Nick, and then Augustine, if you put your question in the chat, I'll still give you another chance to come back, but at least we've got the question there. So Nick.
Thanks. Hi, Cal. So money's obviously super important, but as you said, you're using it to hire talent. We just closed a early pre-seed round, and so that's our biggest problem. How do you get those talented people? I mean, I know there's a lot of trite things about kind of making the culture right, but how do you tangibly actually find the really important people?
Yeah. Kind of two. I think there might be two questions there. So one is, like, how do we identify anyone we want to hire to begin with? A lot of that was about network early on, like people that we knew, people that we'd worked before, or people that knew people that we knew. Double-edged sword, because it means you have, assuming that you've worked in the industry before, you have access to people that you already know what they like to work with, but also tends to create very homogenous organizations and cultures. We had to be very explicit to make sure that we hired some women engineers early on, because our network was entirely men. But I think one of the really important skill sets as a founder, regardless of kind of the industry you're in or what you're doing, is being a salesperson for your own organization. Because you presumably are one of the strongest believers in what you're doing, but you really need to be able to convince other people of that. People aren't joining a startup because they're going to be better comped. In general, you're going to be paid a lot worse. You'll probably have to work longer hours, but you really have to be bought into the vision of it. And so, early on, I spent a huge amount of my time recruiting, but a lot of that time was spent selling people, selling people on the vision, what it could become, why it was exciting, why this is a good way to spend the next few years of your life, even if it isn't successful, and why it will be, why it will be a great journey to be on. And selling people is hugely important. And even when you're having, a crappy day and something's going poorly and you can't, figure out whatever it is in your regular job, being able to switch into I am so excited about the future of this company, let me tell you why it's great mode, is really important, and is a practiced skill like anything else. And you just have to keep practicing selling people on it. But I do find that in general, during that period of the first few years, that I would avoid trying to sell my friends on the company, because I just wanted to keep all of my selling energy to people I was trying to hire. So it'd be when I talk about my job outside of work, I'd be this is this company that we're doing. I'm going to save all of my energy for when it matters, because I ended up spending so many thousands of hours talking to people about why I thought this was the company to join.
So I'm just going to check to see if Augustine's got his mic working okay. But you've also posted in chat, haven't you, Augustine? So
yeah. Okay. So I see your question in the chat there. So the previous game is, we are still the same company. We didn't reincorporate after the game. And so we still have our same original investors. In fact, they were pretty happy when we switched to doing enterprise software, because that's the kind of the industry they're much more familiar with, and were much more comfortable after we quit doing games. To some extent, they felt well, good, now you've failed with the games thing, you can get on and do something that we understand. And it was very much, they invested in the team and they believed in the team. And in both cases, so Excel, who were our Series A, we knew our partner from Excel, Andrew Bracher, was worked at Yahoo when we were acquired by Yahoo. So we had a relationship there, and we'd had a prior relationship with Excel as well when we almost raised money from them back in 2004 when we were building Flickr. And then Andreesen Horowitz, Mark Andreessen, had been an angel investor in both the company that built Flickr and then the game company. And so once they formed their VC, it was kind of natural for us to bring them on board. But their expertise was enterprise software as well. And so they were happy to kind of both still have invested in the company as we switched to Slack, and then they participated in every round, you know, in their pro rata after that, so stayed invested in the company and believed in it for the long term. And both Andrew and John O'Farrell are still on the board today as a public company, although because they are VCs, they will be rolling off the board as we rotate our board out now that we've become a public company. And that's also, like, we have no time to talk about it now, but a whole interesting experience of, as we became a public company, changing our board to have a public company board, which is a very different orientation to a startup board.
Yeah. Can I maybe finish off with one other, with sort of go to the end of the story, in a way, the end of the finance story, or at the end, but the direct listing at the end. And obviously a lot of people know about that. You're one of the very few people who didn't do a traditional IPO and hire investment bankers, you know, allocate to high frequency hedge funds and things like that. But what was the thinking behind it, and was it? Would you recommend it to other people?
So slight misconception is we still hire investment bankers, and it's still Morgan and Goldman and and Allen and Bain and all of the same people are still involved, and you end up giving them the same amount of money, but the big difference is no allocations. So you're not letting them, sell shares to their friends. The big difference for us, and the reason why we chose it, is it gives employees immediate liquidity. Well, two things. One is that we don't have a 180-day lockup period, which is, really what has screwed over a lot of companies, employees at companies going public, that they have this long period in which the stock can really slump, and then employees kind of miss out. But also those 180 days are incredibly unproductive for organizations, as employees are sitting looking at the stock price every day and kind of tie their self-worth, because it's also their net worth, to the stock market moving up and down, which is usually completely unrelated to anything the company is doing. The other piece for us was we just had a lot of cash on hand, and we didn't need to raise any more money at the time, and we didn't want to take the dilution of selling off more stock. And so because we didn't need money, and because we wanted employee liquidity, and because we were just on the cusp of being well known enough that it made sense, it was easier for Spotify because they're a household name. But we had to, the key to a successful direct listing is liquidity. So we had to have enough shareholders, existing shareholders that were on board selling on day one, and we had to have enough market interest to actually, buy through that liquidity. And it was definitely risky for us because there's only one company that's done it before at scale. Who knew what would happen? It worked out okay, although our valuation went way too high on the first day, and the opening trade was, it took us most of a year to get back to that rate, and that was a very aggressively high price. But that stock market is kind of stupid, doesn't mean anything.
Still, it sounds like a founder's dream, really, doesn't it? So this has been fantastic again, Cal. So we're really delighted. I hope that we're hoping to bring this group, those who can come next March or May, I think it is, over to California, and give them some of the experience that they couldn't have this time round. So hopefully we'll meet then, and
hopefully our office will be open then and you can come visit, but we'll see.
We'll see. I hope so. Well, Tim and I are still planning on our little trip, so and Alan's hoping to come in the other direction to Oxford. So I usually end these sessions by saying, it would be really lovely to see you in Oxford, and it would. And let's hope we're all back traveling soon. So, thank you very much. It was amazing. Great way to start.
Oh, wonderful. Thanks.
Yeah, thank you.
All right. Have a great rest of your day. Thanks, everybody.
Thank you. Okay.
Bye-bye.
Bye. Good. Right. Well, thank you for bringing guests. That's good. Digital hands. That's an excellent idea. So
well, I think, Tim, we need to kind of try and get a bit more of this going during the week. So you can have 2 different reactions: thumbs up or a digital hand.
Yeah.
And then we could do the wearing of the hats. You know, we could have a different thing each day.
Oh yeah. Oh yeah. So this is going to make it. But this is the way to get the course evaluations up, is it, Kathy?
Yes. Without that, you're doomed.
Yeah. Good. Well, I hope you enjoyed that. That was great, I think, and really interesting to hear about their journey. And it sort of involved a lot of the things that we went, we will touch on along the route, including pivots and goodness knows what. But we're going to go in our final session straight away to talk about the guidebook case. It's great to see Jeff Lewis, who's here, who is good to see you, even albeit over Zoom, Jeff. But been a few months. We normally see Jeff twice a year, and I feel like we've missed him in 2020. So, but great to see you, and thanks for being here. Jeff is
one quick thing. Hi, Jeff. But I was looking for it while we were wrapping up Cal, and I couldn't find it. I think it was yesterday or the day before in the FT.
Yeah.
There was a long interview with the founder of the company called Automatic, which is WordPress. That's their mode. They just bought Tumblr. And it's a very interesting discussion of how to have about a company that has over 1,000 employees and they're all distributed. Mm-hmm. So it's we touched on that in several instances with Zoom and Slack, and you might track that down. You'll find it actually, I think, pretty interesting.
Yeah.
Thanks, Alan.
So I think what we're going to do now is we're going to switch into Guidebook, which is obviously a company which is established now, but has gone through an entrepreneurial journey, and obviously hasn't quite got to the end of that yet. But it's great to have Jeff Lewis here, who's one of the founders of the company. This is very sort of close to home because Alan was one of the early investors in Guidebook, and so at some point I'm sure they will sort of take over in a way. But Jeff, do you want to just? I guess actually I don't know whether this group uses Guidebook or not, or whether
no. So we used to use Guidebook on the degrees, but we're still using Guidebook in our executive education.
Right.
We bought something ghastly called Canvas, which has a terrible app. But so we're using it quite actively, and yeah, the school's still very much involved.
Yeah, but maybe it'd be a good thing to do, Jeff, just to sort of explain for those who don't know what Guidebook is, maybe what it is and where you are in that sort of entrepreneurial sort of journey.
Sure. First of all, it's great to be back. Can you hear me? Is my audio working? I just want to quickly verify.
No, it's all fine.
Great. Yeah. I'm actually dialing in from my phone because even though my video has been working for the last 3 weeks, my video on my laptop wasn't working this morning, and so I had to dial in from my phone. So I hope it's all I'm coming across clearly. So it's great to be back. It's nice to see everybody. And yeah, so as far as Guidebook, we started the company with kind of just the vision of making it simple to create and manage mobile apps. We started the company in 2011 when kind of the iPhone had already taken off, but it was still kind of early in kind of the app ecosystem. And we thought the market was a pretty straightforward one. There were public companies that made kind of it easy to kind of go and create a website. And we thought the primary way people would use apps, and it turned out to be right, is or use their phones through apps, not kind of always through kind of the browser, but people spend more time in apps than kind of the mobile web, just because it delivers a premium experience that kind of leverages more of the phone. And so, yeah, we kind of made it easy for businesses to create apps, to kind of create communities, offer up information, set reminders, things like that. And we really focused initially on kind of places you could visit, whether it's a university or, a conference that you go to, or a museum, or things like that. And we really wanted to kind of connect people with that venue and with other people visiting that venue.
Yeah, and in terms of the very early days, and there's a certain analogy actually with Slack that I didn't realize. Do you want to just tell us what Guidebook grew out of? In terms of, what were you trying to do to begin with, and how did it develop?
So yeah, it started when a couple of my friends, were kind of tinkering around on 6 or 7 ideas. They, are both technical in nature, computer scientists and designers, and they were just like itching to start a company. And so they, we had all gone to high school together and grew up in the Silicon Valley in Palo Alto, and they didn't really know what they wanted to do. And so they were just kind of doing passion projects. And they created this silly little app called The Conventionist for this convention that they go to. It's a gaming convention where 60,000 people come together and they talk about all the games that are coming out, whether it's board games or video games or whatnot. It's called PAX. And they had something like 40,000 people out of the 60,000 people who go to the show use it, and they got really great feedback. And so they came to me for some advice, just because I had kind of been in technology for a while and had stayed in the Bay Area and kind of worked in startups, and they had left the area and had really worked at startups. They worked at big companies. And so I was kind of reviewing all the different things with them, and we kind of really felt a lot of confidence behind the idea of kind of generalizing that idea beyond just that kind of conference convention use case into something, again, more broad.
Yeah. And one of the things we're going to talk about today, or this session, is the way that the initial funding happens, and also about the cap table, and which is basically who owns the company, right? And this is a very important issue. Like, it's one of the main things you have to keep your eye on if you're an entrepreneur, is how much equity you're giving away. So I'd like to just step, and at some point we've got this, as you know, Jeff, we've got your cap table, and I'm going to put the class into study groups to sort of go and try to work out how it works and see if they can make it work. But could we start for the first bit? I wanted to just talk about those first couple of stages, because you initially needed to raise some capital, and you did it through what's called a convertible note, which all the class should have read because it's there in the case study. But do you want to just give us a sense, and these are ubiquitous, like most people use these to get going, but can you give us a sort of go over to teacher mode and tell us a bit why they're used and what the attractions are to you as an entrepreneur in raising a convertible note issue?
Sure. I'd say it's attractive because you're working, you don't want to go spend a lot of time fundraising. It's a painful process, and the last thing you want to do is kind of bog yourself down in kind of complicated paperwork and negotiations. And the whole purpose of it is, the whole attractiveness is it's quick and easy, and it kind of kicks the can down the road, right? Alan can tell you more about this, but it's difficult to value a super early stage startup, whether it's just launched or it's just an idea. It's difficult to do, and so it really just kind of allows the investor and the entrepreneur to kind of move forward in as quickly as kind of a day or two, even if you want. And so that was kind of the attractiveness behind going that route.
Yeah. And Alan, from your perspective, do you always invest initially through these instruments? And they appear to have some features. People look at them and think, are these debt? They look like a note, which is almost like a debt instrument, right? But could you just sort of give a sense as to whether that's the way why you invest in through that route?
Well, there's several reasons. One, and typically convertible notes are used in the very early stage, the first, sometimes the second financing of a company, but usually just the first. And the reason, as Jeff pointed out, is that most of the things that you negotiate in what's called a priced round, where you actually create and sell stock, most of the points of negotiation are kicked down the road. So you defer them until there's a lead investor that comes in your next financing and negotiates those. So you avoid a lot of time, energy, and legal fees in doing a convertible note. There's a, well, it's not so new anymore. There's another instrument called a SAFE, which is an acronym for something, simple agreement for future equity, I think it is. That is essentially, I mean, a convertible note is just a type of contract, and a SAFE is just another similar kind of contract. But mainly the benefit is they're simpler, there are fewer things to negotiate, and so you can quickly move on. As Jeff correctly pointed out, you also can, to some degree, defer the negotiation over valuation, which is, as we'll learn over the course of this week, in a startup is very hard to do. There's very little sort of guidance that you can use other than sort of experience.
Yeah. And so I should say, by the way, if anybody's got any questions for Jeff at any point, you know, even though this is a case study sort of session, but feel free to put your hand up and I'll come on to you.
And actually, one other thing, and I think Jeff would agree, no one who, at least around here in Silicon Valley, who invests in a convertible note thinks they're really loaning money to the company and that they will get repaid. It really is a way of making a quasi equity investment. And the historical form of putting it in a promissory note that converts into stock is purely artificial. That is, nobody really thinks they're loaning money to a company, or if they do, they are unsophisticated and shouldn't be doing that transaction.
Yeah. So you raised this relatively small amount of money on a convertible note, and how and then what was then the idea of these is that you're going to go and raise a round where there will be a price and a valuation put on it relatively quickly. Can you just give us a sense as to, so how quickly did that happen in your case? And when you were thinking about how much to raise, what was in your mind? What were the options you were thinking of? Because we were talking a bit earlier about Silicon Valley, the sort of rush for growth, and you know, sometimes raise more money than you need and the like. So what was your philosophy on this?
Yeah, so we had tried, just so you know, in conjunction with the angel round, we kind of tested, you know, there was fewer seed investments happening at that time. And so it was like, should we just go for kind of our Series A? And so we had kind of called up a few firms that, and we were confident, you know, we had a good product and a good team. We actually had some revenue coming in, and we kind of struck out. And so we were like, okay, maybe it's not so easy to just go and raise the Series A of kind of, you know, $5 million, $6 million, even though, you know, we had, or I had a CEO kind of experience kind of leading some meaningful efforts at some venture-backed companies. And so it kind of brought us back to reality and said, okay, well, you know, we're looking at going much longer without any pay and kind of digging deeper into our savings and stuff. And so what do we want to do? And so a big reason for the convertible notes that we raised was just so we can kind of get some people on our side who could help us fundraise. And so that was one of the main value props kind of Alan brought to the table and really game planned with us from even kind of before he was, you know, he made the investment. He kind of already started working with us on kind of a game plan for how we could raise money, because, you know, it's painful kind of quitting your job, stopping all income, and kind of working on a project, even if you do have a lot of momentum and it seems like it's going really well. You know, you're still kind of excited on one hand, but kind of suffering on the other hand with kind of house payments and things like that. And you're kind of just always worried in the back of your mind. So the goal is, how do I just like take this out of the equation so I can kind of 100% focus myself on the business. And so, yeah, we wanted to raise, you know, pretty much immediately afterwards. We had a small team, and it was probably 5 or 6 people by the time the round with Alan and the co-investors closed. And we had probably, you know, more friends that we knew were talented and wanted to join the company than we could hire, even if we did raise a pretty substantial round. And so we were kind of just eager to kind of put our foot on the gas and get going. And so, yeah, I think if the next month we had kind of received kind of some competitive offers from firms, we would have probably, if they were kind of on terms that we liked, we probably would have gone for them. But it ended up taking a little bit longer to find the right firm. We didn't necessarily just want to raise a round where we would kind of get dilution of kind of a third of the company right out of the gates. And so that was a big limiting factor for us, because when we did talk to these firms, they did want that ownership stake up pretty meaningfully to that 30–40% mark. And we were hoping to kind of, you know, sell, you know, 15% or so of the company. Just because when we were talking to our peer entrepreneurs who were kind of out there, you know, we had meaningful revenues of, you know, I forget exactly what they were at the time, but I think there were kind of hundreds of thousands of dollars of kind of cash coming into the business every month. And so we felt like we were a little bit ahead of some of those other companies that were out there raising. And so we thought we could kind of command that. And it took us longer to find a firm that was willing to kind of deal with us with the ownership stake that we kind of had in mind of kind of giving up for that round.
Yeah. Now, what I want you to do at this stage, because I want you to sort of see the way these things work. So what I'm going to do is, hopefully you've downloaded the spreadsheet from the course website. But what I want to do is to just get you to go into groups for sort of 15 minutes and try to work through what it really meant to Jeff and his company as they went into this round. So what I've done is we've got a very, very simple cap table here, which I hope you can be seeing. And there's two tabs to this, one of which is where we have the cap table with the debt discount, and one with a conversion cap. Now, we haven't talked about those, but they're there in the case. And we will, so what I want you to do is to try to work it out. Hopefully you've read the case and you can sort of give it a go. What we've done here is create a cap table where the only things you should fill in are the blue cells, right? You fill in all the others, you're going to overwrite formulae and you're going to screw things up. But if you start putting in the data from the case, it'll show you how much of the company Jeff was giving up in the Series A, and indeed how much of the company Alan and his co-investors got went through the convertible note round. Because to begin with, they didn't get any shares at all. The shares only became into existence, really, once the Series A was done. And so I'm going to give you sort of 15 minutes until, say, a bit less than that, maybe 12 minutes till 15 minutes. We'll give you that to work it through and see whether you can see the impact of either having a discount on the price, because clearly there's got to be some incentive to invest. And if you invest early, you should get the shares at a slightly lower price, is the way it normally works. Or on the second tab, you can see the effect of putting in a cap on the valuation that will be used at the Series A round. And I won't say any more than that. I want you to try to figure it out for yourself. So the sort of idea here is to fill out the blue cells and see where you get to. One final thing to say is, I've put in a pre-money value here as just a sort of a holding cell, that first one there. Just overwrite it with the value that Jeff got in the Series A funding round, and everything will be fine. That's just there to stop all the numbers exploding to infinity. So you can overwrite those cells, but I'll give you 15 minutes just to have a go at that. Jeff and Alan, you'll get put into study groups, but don't accept, okay? Because otherwise you'll be able to tell them the answer. So I'm going to stop sharing now, and actually I might be able to put you in.
Yeah, just click later, or perhaps you either got to do it randomly, Tim, or you could put all of us in the study group.
Okay, I'm going to stop sharing and then I'm going to put you all into study groups, right, into breakout rooms. So
I'm being summoned downstairs for some kind of quick conference by headquarters.
That's absolutely
what
fine.
time are we rejoining? In 15 minutes?
Yeah, that's right. So I'll just open all the rooms. I'm going to recreate the rooms with new people. So you'll get new people this time round, and I'm going to make them so that you can see if you can help each other understand this stuff. So I'm just creating the rooms now, and we'll meet back up in 15 minutes. Check whether people got this right. So essentially, you know, I'm just going to share my screen here. So you've got this cap table, and one of the most, okay, so the first important thing about the cap table is it's got to add up to 100%. This shows what the ownership of the company actually is. And so in this case, what we have to do, the ownership that you've got in the company, or the amount that you will give up when you have any funding round, is a function of two things: how much capital you raise and at what valuation. Because the less capital you raise at the higher valuation, then you'll be able to raise that money by giving up fewer shares, and vice versa. So that's why the sort of valuation number is very important, and how much you raise is very important. And so in this case, we know that the amount that was actually raised was raised at a pre-money valuation of $18.8 million. So I'm just going to put that into the pre-money value there. So that was basically saying that the value of Guidebook, when Jeff went for this sort of first funding round after the convertible note, they said, we think this is worth 18.8 million. And they said, and at that point, at that round, Jeff raised 1.7 million. So I'm going to put 1.7 million into the Series A. And and at that stage, you can start seeing things start to populate. So essentially, if you've got a pre-money value of 18.8 and you've raised 1.7, that means you've got a post-money value of just over 20 million. Because the post-money is just the pre-money value plus any money that you've put into the firm. But of course, before that, they'd also had these convertible notes, which was 200,000. But remember, the convertible notes actually had an interest rate associated with them. So that was the sort of debt part of it. So you have to, and they were invested for 2 years in this case. So therefore, we have to put into here not just 200,000, but we have to allow for the fact that there was interest as well. So I'm going to do star 1.04, the interest rate to the power of 2. So compound interest on these things. So to the power of 2 should give us the amount that of the value of the note at the point in which it sort of got matured. It matured. Whoops. Yes, I think I will accept that. So that means the note was actually worth, at the time that it matured, 216,320. And so at this stage, then, you can see the way the cap table's working in terms of if these had been put in at the same price at the pre-money value of 18.8 million, then Alan and his co-investors would have got just over 1% of the company, and Jeff would have given up 8% to the Series A investors. But of course, Alan didn't put in his money at that level, because he actually, you know, got a discount to the share price, and so that was it was a 20% discount, right? So that was a 20% discount to the share price that the Series A investors got for the additional risk that was taken there. And so that was, and that means that you can see here that the share price for the note holders is actually lower than the share price for the Series A. Okay, so let me just stop at that stage and just check if anybody's got any questions. about how this is all working before we just deal with the final step.
And one, in case someone has the question but isn't asking it, the reason for the discount is the additional risk that the earlier investors are taking in the company. So the later stage that you invest, the less risk you take because the more information you have. So the discount is a pretty arbitrary measurement of the additional risk that you're taking by investing in a convertible note at an earlier stage.
So at this stage, Jeff and his co-founders still own are owning 90% of the company, and Alan's stake, or Alan and his co-investors' stake, has gone up to 1.32, and the Series A is at 8.2 now, at 9. Now the last bit of the jigsaw puzzle is the option pool, and the option pool is there because in order to grow the company, you don't want to pay market wages, so you're going to have to some extent pay people with stock, and it's also good for incentives and aligning people's interests. And so in this case, at that round, the investors said that you should create an option pool of 12.5%. Okay, so I want you to look what happens here to the numbers as you create this 12.5% option pool. Okay, who pays for the 12.5% option pool? Well, you probably saw that the people who paid for it were the founders, and that's why it's called a post-money pool, option pool. Essentially, it's like saying we've given you, just instantaneously before you sort of we get our shares, we sort of pay for them with some of your shares, and because the Series A and the convertible note holders are not getting diluted in that act. Now, of course, those shares haven't been allocated yet. They're there for the future, but it's an interesting feature of these cap tables and the way they work is that, in a sense, the initial investors do not get diluted by that creation of the options. Okay.
Tim, a quick, and Jeff can comment here too, but the rationale for that, because it can seem unfair to an entrepreneur, but the rationale is that the investor is financing the company to the next financing. And the number of shares reserved in the option pool is supposed to be everybody's best estimate of how much of the company you will need to grant to employees between the date of this investment and the date of the next investment. It turns out that it's usually just an estimation that is some round number like 10% or 12.5% or 15%, or probably the most common is 20%. But Jeff's pool was smaller because the team that they had assembled was already larger than most teams at their stage of financing, because they had been able to finance a lot of their growth with their own revenue.
And Jeff, can you give us a sense as to, for you were employing engineers, I guess, with some of the most important people, but I guess a lot of people wonder, like, how much stock do you give to somebody like that? So without, just in generic terms, what sort of, how much would you pay a decent, experienced engineer, and how much stock would you give them early on?
Sure. This was a while ago, and so just keep that in mind. But I think we gave our first engineer that we knew really well and knew would be able to scale with our business, and who is still with this business almost 10 years later, 0.5% of the company. And we have subsequently given him additional grants, but his initial grant was 0.5%. And then other key early people maybe got 0.25%. The next 3 or 4 hires, either technical or people who are going to be leading teams on the kind of business side. But talking with my group, as part of one of the breakout groups, I think one thing important to highlight to the class, why we're going why there are two tabs, and there's kind of two theoreticals, is because the convertible note itself has two mechanisms to convert. I don't know if you want to cover that, you guys, or even I can, but it's a kind of an either or, right? It's either, so Alan's giving us this money, and it either can convert at a debt discount. It's called a debt discount in this sheet, but it's kind of like a, you know, like you said, Alan, you're investing early, and this is a debt instrument, but it's typically, you know, perceived as, well, I'm giving you this money now, you might not raise for 6 months or a year or 2 years in, you know, our case, plus or minus. And so, you know, I want that to count for something. And so that's kind of what the discount is, even though it's kind of named a debt discount. And so this case, you know, protects, I think, you know, we talked about this in our group. This case this first tab is good if we convert at a round that's lower than the cap, right? But in this case, it's higher than the cap. And so you know, how does it compare to the other tab?
Yeah. And so maybe we'll touch on that, because you're right that I didn't really explain it too much. It's there in the case study, but there's another mechanism, which is an either or, as Jeff said. You either there's two protections for Alan and the convertible note holders, and one of which is to say how much, what is the maximum value at which this will convert, and you can do the same sort of thing here. It's a bit like saying, what is the minimum percentage of the company that I will get once the Series A investors come in? And the idea there is that if you came in and actually the next round had been at $1 billion, then Alan's investment of, let's say, $200,000 would have ended up with a very tiny stake in that business, right? And he wouldn't have got any of the benefit of that huge round. And so what you do is essentially say, well, we'll get a 20% discount, but the maximum value at which you will strike my shares, as it were, is given by, you negotiate that. And in this case, it was $6 million, right? I think in terms of the valuation cap. So you can do the same calculation again, and you get either or, you don't get both. So you either, in this case, we've got the Series A, it's still the same valuation, still the same investment. The convertible notes is still the same sum of money, 200,000 times 1.04 to the power of 2. And I make the same mistake again, must have put in the wrong thing. And the cap here was $6 million, right? So I'm going to put in the cap. So that's the maximum that the shares could be valued, even though the post-money value was actually 20 million. We'll also put in the post-money pool there to make it all work out. So the philosophy here is Alan and his friends put in $216,000. When you're working out the share price, you don't use the post-money value of 20,000, or the pre-money value, if you like, of 18.8. You actually use a value of 6. And that means you get many more shares, roughly 3 times as many shares, as you see here. So in this case, you ended up, it was better for Alan to have his shares valued at a cap of 6 million than have his shares valued at a 20% discount to this price here. Okay, and so this is pretty common, because if you put in here, if you didn't have the conversion cap, let's just do something which will probably break the whole system. But let's put an extra 0 in here for a minute and say that Jeff's, you know, share in the company or Jeff's funding round would have been 180 million instead. You'd see that Alan would only have had 14.14% of the business, a sort of very small stake in it. And after that, it might not grow very much. And so it's a way, in a way, it's a way of protecting the early investors from, you know, a super successful funding round. But Jeff, Alan, is there anything you want to add on that, on the philosophy? Because it might be you have a different way of expressing it.
I was sort of involved in these convertible notes evolved over the 40 years that I've been out here. And in the beginning, people just used straight promissory notes. Then the point was made that that was unfair to the investors who were taking additional risk compared to the later investors. So we started doing notes with discounts. Then somebody made the point that there was, with a discount but no cap, there was a perverse incentive to the early investors not to help the company. And the reason is, the more you help the company, the less you got at the conversion. So if in Jeff's case, if the early investors had been super helpful and his next financing had been at $188 million, the percentage ownership would have been quite small. So we started putting conversion valuation caps in so that no early investor would have any qualms about helping the company. And that's the sort of the way that they evolved.
Yeah.
It is a sort of a disguised, I mentioned, and Tim mentioned, and Jeff mentioned, that it's very hard to value a startup at the stage where Jeff took in his first money. But the conversion cap is, in a sense, a sort of disguised quasi-valuation that the parties agreed to.
Yeah.
Tim, I don't know if you've seen, you've got a question in the chat about where did you get the 20% debt discount from?
Okay, and the answer to that is convention, I think. I think there's almost no discussion about it, is there, in the Valley, in terms of, it's one of those strange numbers that comes out, or is given to you on tablets of stone, I think. Is that right, Jeff?
So yeah, as far as where the number actually comes from, it's documented in the convertible note. And then as far as why it's 20% versus something else, yeah, it's you know, it's mostly convention. I mean, these things are somewhat negotiable, but you know, at these early stages, when an investor is coming in and your office is a shabby little 3-person, 3-desk situation, or 4 desks, and you know, you just want to get the round done. It's almost like, okay, well, why do we want to break with convention? Why are you a special case? And, you know, although we could have haggled on all of these things, it's not really the impression you want to kind of give off as an entrepreneur. As you know, it's early stage, you're kind of trying to recruit investors who are aligned with you. The last thing you kind of want to do is say, like, we're some special case where you, as an early investor, even though you're taking a risk on us, and we all know that, you should still pay some sort of premium. It seems kind of petty and kind of potentially jeopardizing kind of the whole thing, because these early guys like Alan are judging you based on, who knows what, but is he ethical? Is he going to treat me fairly? All these things, and it seemed like even if we negotiated that a little bit better, it was kind of pretty much meaningless to kind of get something slightly better.
Yeah. And Laurent, I see you have your hand up. So do you want to
just one? I think one comment, sort of to pile on Jeff's comment, because Jeff correctly or described. There will be a recurring theme throughout this week that things that are quite common, like a 20% discount, are entirely conventional. And they're conventional in the sense that they have evolved over the last 40 or 50 years. And using these conventions allows the ecosystem to continue to thrive. But there will be at least a dozen more times during the week that one of you will ask, well, why is that the case? And the answer will be, because it works. And that's it.
Laurent, do you want to ask a question?
Yeah, a quick one on, from my understanding, on the employee options. Is there an exercise price there that is relevant for those options, or it's not relevant into the calculation?
I don't think it's relevant to the calculation. Was there an exercise price on the options, Jeff, or were they? Because often in many of these cases, the company doesn't necessarily have much value in terms of striking the options for tax purposes. But do you remember whether there was a strike price on yours, Jeff?
Yeah. So when you typically, it's a strange process where you raise this round and you don't always go for like the maximum valuation, but you could possibly there's reasons you may not want to raise it too high of a valuation, but generally you want to at least make sure you're trying to get what you believe is a fair valuation. And generally talking to investors, they're trying to own more of the company. They're trying to negotiate it down. And so it's a silly thing where at first you're trying to say, why is my company so valuable? Here it is. And then the moment you close the round, you go through this process called a 409A valuation, where you get a third party to come in and value the common shares so that you can kind of create an option pool for your employees. And obviously you want that strike price to be as low as possible so that you can kind of incentivize them. If it's a really high strike price, they're like, well, this doesn't really help me out because, we need to gain a lot of ground from where we already are in order for these to be valuable. You want it to be really low. And so you then, flip the table and you're kind of arguing with the firm that's kind of valuing you why you're not worth just kind of the valuation you raised at. It's easier for common shares because common shares have, or preferred shares are called preferred because they, have preference to common shares. The company doesn't sell for a certain amount. The common shareholders won't receive anything. The preferred shareholders get seats on the board and have more ability to kind of control where the company goes. And so, I haven't kind of gone through this for a little while at the early stages, but maybe somewhere between 10 and 25% is the usual range. Alan, do you think of kind of reasonably arguing kind of what a common share is worth versus kind of a preferred share? Maybe closer to the 10, 15% range?
I think that's right. So I think, Laurent, to answer your question, at the time the option pool is established, you don't have any price on the shares. And the reason is in the US, the tax law requires that you establish the exercise price per share as the fair market value on the date that the grant is made. So over time, that will vary. And in Jeff's case, because his company's been successful, that went up over time. The process Jeff mentioned is that in order to establish a safe harbor for your price, because if you don't, there are adverse tax consequences, you have a valuation of your company done, or technically you have a valuation of the common stock. And as Jeff pointed out, as the founder and CEO of his company, he wants the exercise price to be as low as possible because he wants to provide the maximum upside incentive to his employees. So immediately after negotiating with our lead investor in the round why we should have a higher valuation, you turn around and argue with the different firm, discuss, negotiate to get a lower valuation. But in general, I think, Jeff, you're right. It's earlier on in a company's history, it's probably more 10%. Then over time, the difference between the common price and the preferred price will shrink as it becomes more and more likely that the preferred stock will convert into common, and we'll go over that, I think, Wednesday.
Yeah, and just to point out that in case some of you haven't spotted this, that the shares that that Alan and the venture capitalists get are preferred shares, which have certain rights which go above the shares that the entrepreneurs have, which are ordinary shares. And we'll talk about that in the so-called financial structuring session, how the different varieties of those, but that's just one thing to bear in mind there. I see, Steve, you've got your hand up as well. So do you want to ask your question?
Yeah, I just want to confirm that. So you said that 20% was a fairly standard discount for the note holders. and also the $6 million, I mean, all these things are negotiable, but these things are kind of a starting point. Is that fair to say?
Yes. In fact, almost everything on the screen that Tim is sharing is conventional within a narrow range. The $6 million is probably a bit higher for a cap than most startups. It's probably 4 or 5, but Jeff's company was already generating revenue. It was clear that there was a market for his product, et cetera, so he deserved a higher cap. 20%, Jeff, I don't know as you talk to your friends out there in entrepreneur land, but my experience is 20% is probably 90% of the cases. And the interest rate will vary, but it's usually nobody invests, as I said, none of these is a real debt investment or a loan to the company. These are disguised or quasi-equity investments.
Yeah. Now I realize time's getting on and we've got to let Jeff start his day and you've got to finish your day as well, and we've got to finish our day. But Jeff, could you just give us a sort of update on, like, the quick what happened next? And because it's great to have, partly because we don't actually know what happened next over the last year, but just tell us a bit what happened after that one, that funding round. I know you closed another one after that. Do you want to just give us a bit of a flavor as to what's been going on?
Sure. So, we continued to grow after that that round, which was the $1.7 million round. That was a really great round for us because it wasn't so much money that we were just like, let's just start spending it, put it into use. We were really thoughtful around kind of just how we wanted to expand. And so we grew, and we didn't burn too much money in that process. So then we did raise, I think, another $10 million kind of 3 or 4 years later at I think it's, again, we've been at this business for a while, but I think the valuation was around kind of $30 million or so for our pre-money valuation. And so we gave up about 25% of the business for that 10 million, because the post money I think was a little bit over $40 million. And we continued to grow.
Jeff, that fund was based in London, right? That's Toby.
Yep, that firm's called Mosaic Ventures, based out of London. We were starting to expand into Europe, and so we wanted someone kind of help us with international expansion. We kind of felt we had the U.S. market. We had enough help kind of stateside. And so they've been helpful, as and after that, we haven't raised kind of another round. We turned profitable, and pre-COVID, we were kind of starting to EBITDA was starting to get somewhat meaningful. We never kind of figured out how to scale indefinitely. We would have loved, our ARR as a business, which is kind of a classic SaaS metric, was between the $15 and $20 million range. And so it was certainly a success but it wasn't kind of the breakout company that makes funds and kind of you hear about in the news, or we weren't kind of considering an IPO or anything. We're like, okay, we haven't raised all that much capital. We haven't raised $100 million or anything like that. And so, for kind of the early investors, it would work out. We would kind of return kind of a multiple. We were looking to exit, and then COVID hit, and so we a large part of our business is the events business, and so obviously people are not congregating, and so that's kind of what we're dealing with now. We have about 40% of our business was events, and so we basically it wiped out kind of our EBITDA margin. So we went from kind of it being a profitable company of kind of 25% margins to kind of back to burn mode. We were burning 15. And so we kind of downsized a little bit, cut some expenses, and we're kind of waiting around for the economy to pick back up and for us to kind of get through COVID, for us to kind of recoup some of that lost revenues. A lot of our clients say, we love your solution. We've been with you for 6 years, but we've just canceled all our events, so we don't need your solution for conferences and meetings, you know, this year. And so we're hoping that, you know, we can regain all those customers afterwards and kind of get back to that profitability mode.
Right. Well, I really hope it works out, and that it doesn't last too long. And as you know, and it's been great having you back here again. And we really hope, apart from the fact that, you know, you helped us write this case study for you and used your real material, like this is not fake. This is real. So that is the convertible note. So Jeff, thanks ever so much again for participating. You've been a loyal supporter over all of our sessions. So we just hope to see you again in Palo Alto in 2021, and best of luck with the business, and hope it all gets back to business soon. So thanks very much indeed.
Yeah, thanks.
Yeah, all the best, Jeff.
If I'll ping you, we'll grab socially distanced coffee.
And so that's it for today. We'll finish at this point and reconvene at whatever it is your time, but 12 our time tomorrow. And if there's any questions you've got about anything we've done on the first day, we can take them at the start of next time. But have a good evening or the rest of your day, and we'll see you tomorrow. Thanks.
Thank you.
Guys.
Thank you. Bye.